Hello students, today we are going to start with our next head of income, that is income from capital gain. Income from capital gain is given under chapter number 4 under unit number 4, that is capital gain, on page number 4.358 of ICS study material. If you don't have the physical copy of the ICS study material, don't worry, you can download this PDF from the ICS website. If you don't know how to download the PDF from the ICS website, don't worry, you can download it from the link given in the description below. Okay. The notes that you are seeing right now on your screens are available for download. The notes are available in the Telegram group. The link for the Telegram group is given in the description below. Okay students, so before understanding the main provision of this chapter, let's understand this chapter in a layman term and let's understand how this chapter will flow. Okay, so for that let's come into a blank page. Understand that this is our assessee, Mr. Shyam. Okay, Mr. Shyam is having a capital asset. Okay, so you all might be thinking, what does capital asset means? So don't worry, in our notes what does capital asset means, you will understand it at a later stage, but for time being understand the flow. Okay, so Mr. Shyam is having a capital asset, and for the simplicity of the flow of explanation, understand that this capital asset is house property. In bracket it is a flat. Okay, so Mr. Shyam is thinking to sell the house property. Okay, the primary concern of Mr. Shyam is whether on such sale Mr. Shyam will need to pay tax. So this is the primary concern of Mr. Shyam. So this is the primary concern of any assessee who is having a capital asset, and in our example the capital asset is a flat. Because we have not studied what does capital asset means, in a later stage after understanding this flow we will understand what does capital asset means. Okay, so in our example we took capital asset as a flat and Mr. Shyam is thinking to sell this house property, okay, which is a capital asset. So Mr. Shyam is thinking whether on such sale Mr. Shyam will need to pay tax or not. So the answer is it depends. Okay, it depends, because income from capital gain head has many sections, okay, under which we have to calculate the value of taxable capital gain earned by Mr. Shyam. Okay, so this is what we are going to learn in this chapter, that is income from capital gain head. I hope this is quite clear. But Mr. Shyam is telling us that after selling this house property, that is the capital asset which is owned by Mr. Shyam is thinking to purchase another house property. Okay, so will he need to pay tax on that? So the answer is again it depends, because in income from capital gain head there are provisions given under section 54 where we can purchase a subsequent capital asset after the sale of previous capital asset, and if such capital asset that was previously sold and there was a capital gain and the entire amount of capital gain is utilized in purchase of the new capital asset. Okay, for example, understand that after sale of this old capital asset which was flat of Mr. Shyam is purchasing again a new flat. Okay, so whether the capital gain, okay, calculated as per the income from capital gain head can be utilized against the purchase of new house property, the answer is yes. Okay, so this is what also we are going to study in our chapter. Okay, so don't worry about that, this is a very simple chapter, you just need to be very patient. Once you have understood this, it is very difficult to ununderstand it because it is very practical. Okay, because everyone at least have some of the capital asset which they will sell. Even if you as a student have a share, okay, that is a equity share of a listed company, okay, that is also a capital asset. Okay, so what all are the capital asset that we are going to study any which ways in our notes. Okay, so don't worry about that. So I hope you all have understood this flow, what we are going to study in this chapter. We are basically going to study if an assessee is having a capital asset and if such assessee is wanting to sell such capital asset on such sale of the capital asset, the assessee will derive capital gain. CG stands for capital gain and not central government. Okay, and on this capital gain, how much tax will be payable? Okay, so there are different rates given under the head income from capital gain for calculation of the tax on capital gain. Okay, I hope this is quite clear to you all. So let's move into our notes and understand the main provisions of this chapter. Okay, so this is the table of all the sections that are covered under the head income from capital gain. I hope this is quite clear. So the first section is section 45. Section 45 talks about charging section, that is how capital gain calculated under the head income from capital gain head will be chargeable to tax. Okay. Second section is section 46 and 47. It talks about transaction not regarded as transfer. So what does this transfer means? It is a technical word we will study. Okay. So for timing, just understand that transaction not regarded as transfer. Section 48 helps us in computation of the capital gain. Okay. Section 49 talks about cost of acquisition. Section 50 talks about consideration. What does consideration means? Consideration means when you are selling a capital asset, you will be selling this capital asset for some consideration. Consideration can be in a form of money or it can be in a form of kind. I hope this is quite clear to you all. Okay. The next section is section 51. Section 51 talks about forfeiture of advance. We have already studied this in income from other sources. Okay. But we have not studied it in detail. So we will study this forfeiture of advance in detail in this chapter, that is income from capital gain. I hope this is quite clear. So the next section is section 54. Section 54 talks about exemption. What does exemption means? If an assessee, okay, sells capital asset, okay, and it derives a capital gain, so can this capital gain be utilized against purchase of another capital asset? Okay, so that is what it is given in this section, that is section 54 exemption. I hope this is quite clear. So basically this is not section 10 exemption, this is section 54 exemption specifically given under the head income from capital gain. I hope this is quite clear. The next section is section 55. Section 55 talks about cost of acquisition and cost of improvement. Okay, so I hope you all have understood this table. Okay students, so now let's understand this part. What does this part is about? This part is about capital gain will arise to a particular assessee if such assessee transfers the capital asset. Okay, so if a capital gain arises, it will be chargeable under the head income from capital gain under section 45. Okay, and what does capital asset means? Capital asset means is given under section 2 subsection 14. And what does transfer of capital asset means? Transfer of capital asset means it is given under section 2 subsection 47. I hope this is quite clear. So basically understand this in this simple manner. A capital gain will arise only when there is a capital asset and such capital asset is transferred, only then the capital gain will arise. I hope this is quite clear. So let's understand section 2 subsection 14. Section 2 subsection 14 talks about capital asset. Capital assets includes all assets whether movable or immovable, or whether tangible or intangible, and such capital asset can be whether in connection with business or profession or for personal use. I hope this is quite clear. And capital assets also includes a right of control of management in respect of Indian company as well as securities held by foreign institutional investor whether as stock in trade or investment, then also it will be considered as capital asset. I hope this is quite clear. So let me tell you one thing, these 2 points 1 and 2 are of least important at your level. Okay, this is basically mostly used at CA final level, but in order to keep the notes complete, okay, and since it is given in your syllabus also, that's why I've covered it over here. But don't worry, not even a single question will be asked from this part. Okay, so basically remember this much part only. Capital assets includes all assets whether movable or immovable, or tangible or intangible asset, and such capital assets can be used in connection with business or profession or for the personal use. That means assessee has purchased the flat. Okay, this flat is a house property first of all, and this house property is used by this assessee for his personal use. Okay, even if this assessee is selling his personal house property, okay, it is also a capital asset. Okay, since this capital asset is transferred, capital gain will get triggered. I hope this is quite clear. And on this capital gain, tax has to be paid. Okay, I hope it is quite clear. I hope you all have understood. Even if the capital asset is a personal capital asset, then also capital gain will be applicable. That is, income from capital gain chapter will be applicable. I hope this is quite clear. So capital assets exclude MGRSS. Okay, what does capital assets exclude? Capital assets exclude MGRSS. What does M stands for? M stands for movable personal asset other than SADA PJ. So what does this SADA PJ means? We have also studied this SADA PJ in income from other sources. Okay, but there we have studied B SADA PJ. Okay, so already you know what the SADA PJ stands for. So SADA PJs, S stands for sculpture, A stands for artwork, B stands for drawing, A stands for archaeological collections, P stands for painting, J stands for jewelry and bullion. So if these are the movable assets, okay, movable assets, so these are considered as capital assets. Okay, other than this capital asset, any other movable assets will be considered as not a capital assets. I hope this is quite clear to you. So in simple words, a mobile phone, okay, even if it is an asset, it won't be considered as capital asset for the purpose of calculating capital gain. Okay, similarly car can also be considered as a movable asset. Since it is a movable asset, it is not a capital asset as per income from capital gain chapter, because it is not covered in this. I hope this is quite clear. So capital assets excludes MGRSS. M stands for movable personal assets other than SADA PJ. SADA PJ means S stands for sculpture, A stands for artwork, D stands for drawing, A stands for archaeological collection, P stands for painting, J stands for jewelry and bullions. Okay, the G in this MGRSS stands for gold bonds of central government, 6.5% or 7% gold bonds. Okay, so basically gold bonds can be given with an interest rate. Okay, 6.5% gold bonds of central government or 7% gold bonds of the central government. So even this gold bonds are not considered as capital asset. I hope this is quite clear to you all. So the next point is our point R. R stands for rural agriculture land in India. If an assessee is having a rural agriculture land in India, then it is not considered as capital asset. I hope this is quite clear to you all. So on the transfer of this rural agriculture land in India, the provision of income from capital gain chapter will not be applicable. I hope this is quite clear, because as per this formula what we have seen, capital gain will arise only when a capital asset is there and such capital asset is transferred. I hope this is quite clear. So if an rural agriculture land is transferred, okay, so that means primarily it is not a capital asset. That means on such transfer capital gain will not arise. I hope this is quite clear to you all. Okay, the next point is point S. S stands for special bearer bonds, or it can be a national defense bond. Okay, if an assessee is having a special bearer bond or a national defense bond, then such bonds are not considered as capital asset. I hope this is quite clear to you all. Then next S in our acronym, that is MGRSS, is stock in trade. That means inventory. Okay, if an assessee is having an inventory, it is not considered as capital asset. I hope this is quite clear. So on the transfer of this inventory, PGPP will be applicable and not capital gain will be applicable. I hope this is quite clear to all. So let's revise this part again. Okay, so capital gain will be triggered only when there is a capital asset and such capital asset is transferred. I hope this is quite clear. What does capital asset means? Capital asset means is given under section 2 subsection 14. So let's understand section 2 subsection 14. Section 2 subsection 14 says that capital assets includes all assets, whether movable or immovable, tangible or intangible, whether in connection with business or profession or personal use. Okay, so that means this capital asset can be used in for business or profession purpose or for personal use also. I hope this is quite clear. This part is basically for CA final level. Capital assets exclude MGRSS. M stands for movable personal assets. G stands for gold bonds of central government, that is 6.5% or 7% gold bonds. R in our acronym, that is MGRSS, stands for rural agriculture land in India. S in our acronym stands for special bearer bonds or national defense bond. S2 stands for stock in trade, that is inventory. Okay, movable personal assets other than SADA PJ. This M has an exception. That means other than this movable personal asset, any other movable personal asset is excluded from being a capital asset. I hope this is quite clear. to you all. That means this is not a capital asset. Okay, movable personal asset other than this. So this means that in simple word, these 6 line items are capital assets. Okay, even if they are movable. I hope this is quite clear. So Sada PJ means S stands for sculpture, A stands for artwork, D stands for drawing, A stands for archaeological collection, P stands for painting, J stands for jewelry and bullions. I hope this is quite clear to you all. Okay, and there is a note given on the first page which says that no deduction under chapter 6A. So whenever we are calculating income from capital gain, so whatever income from capital gain we have derived, we will take into the total income of the assessee, right? So after taking it into the total income, that is the gross total income, the gross total income is further reduced by the deductions under chapter 6A. Okay, under chapter 6A. So the deduction under chapter 6A is not available on the income from capital gain. I hope this is quite clear to you. So that's why I've written it on the first page that no deduction under chapter 6A is available on income from capital gain. I hope this is quite clear to you all. Okay, so now let's understand what does transfer of capital asset means. So in order to understand transfer of capital asset, we need to understand section 2 subsection 47. So on the next page, section 247 is given. Section 247 is talking about transfer, and the acronym to remember this is SEPREC. Okay, what is this acronym? SEPREC. S in our acronym stands for sale of capital asset. So basically transfer will be triggered only when an assessee is selling a capital asset. I hope this is quite clear. Next is E. E stands for exchange of capital asset. Exchange of capital asset is also triggering transfer. I hope this is quite clear to you all. That means you are having this house property, okay, and your neighbor is also there, but you feel that neighbor's house property is having a better view than your view, and this neighbor is also thinking that your house property's view is better. So you all decided to exchange your house property. So if you exchange your house property, it will be also considered as transferred, and on that also capital gain will be triggered. Okay, so this capital gain will be triggered because there is a capital asset and there is a transfer. Even if you are having a house property, that is a flat which is covered as a capital asset, and similarly you are transferring, that means you are exchanging, then capital gain will be triggered. I hope this is quite clear. How it will be triggered, that we will study. Okay, first let's understand this part. Okay, P in our acronym stands for part performance under section 53A. What does part performance means? Don't worry, I have given it over here. We will study it after understanding the entire section, that is section 2 subsection 47. R in our acronym stands for relinquishment of capital asset. What does relinquishment means? Relinquishment means giving up or transferring the right that you are having, or extinguishment of the right in a capital asset. These two are kind of a synonym, but there is a difference. Relinquishment is used in a particular case and extinguishment is used in a particular case. I'll give you an example. Okay, don't worry about that. E in our acronym stands for extinguishment of right in capital asset. C in our acronym stands for compulsory acquisition of capital asset. What does compulsory acquisition of capital asset means? Understand, you are having a bungalow, okay, and the government authority comes and tells you that your house property is between a land where a highway is going to go. So the government is compulsory acquiring your house property and giving you a consideration. So even if the government is compulsory acquiring your capital asset, okay, without your permission, it is also considered as transferred. Okay, you all might be thinking that I just don't wanted to sell my property, still I am getting attracted under this provision of income from capital gain. This is an injustice, but this is not an injustice because the government is going to pay you compensation for such compulsory acquisition of the capital asset. They may either give you the house property in some other area, or they may pay you, okay, in a form of money. I hope this is quite clear to you all. Then the last C, that is C2, stands for conversion of a capital asset into stock in trade. So many of the times, understand it, you are having 10 cars, okay, these 10 cars were your personal assets, okay, you transferred this personal asset, okay, to the business, okay, or else understand this, you have 10 flats, rather understanding it as 10 car, because car is not a capital asset. So understand that you are having a 10 flat, okay, and these were all your personal assets, okay, but they were capital assets, okay, and you have decided to transfer this flat to your business. Okay, since you have transferred this flat to your business, this was earlier capital asset, now it will become stock in trade of business. Okay, so even if you are transferring your personal asset to your personal business only, that is your business of flats, it will be also considered as transfer, because flat fulfills the criteria of capital asset first of all. I hope this is quite clear. And since you are transferring it to your business, it is covered under this transfer, that is section 2 subsection 47. I hope this is quite clear to you all. Okay, so I hope you all understood this part clearly now. How capital gain will trigger, how we will calculate capital gain. We will calculate capital gain if there is a capital asset and such capital asset is transferred. I hope this is quite clear to you all. Okay, transfer of enjoyable rights in immovable property will also be treated as transferred. So what is this? This is basically talking about tenancy right. Okay, so it is kind of an example of extinguishment of a right in capital asset. Don't worry, I'll explain you. Okay students, so now let's understand section 247, that is transfer, in detail. What does sale of capital asset mean? It is quite simple. You are having a capital asset, okay, and you are selling it. Okay, this is very simple. Okay, then capital gain will get triggered. Exchange of capital asset is also very simple. I told you, you are having a house property and there is an adjacent house property. You all both decided to transfer this house property to each other. Okay, so even then also this transfer will get triggered. What does part performance under section 53A means? Okay, so here I have written on the same page what does part performance under section 53A means. If possession is given and consideration is received, that means money or any kind is received, then even if registration is pending, it will be treated as transfer for the purpose of charging capital gain. So what does this means? Understand that this is our assessee. Okay, he is having a house property and adjacent to the house property there is also one house property. So here they both decided, this house property owner is our assessee and this house property's owner is other assessee. Okay, they both decided to exchange their house property. Okay, even if they have not registered this house property in their own names after exchanging, so this assessee's house property will be this. Okay, and this assessee's house property will be this. So even if they say that okay, we will not register the house property in our name in order to skip the stamp duty value that we need to pay to the government, okay, we will simply stay in that. But government says that there is a section under the head income from capital gain, okay, which talks about part performance. Part performance means if a possession is given, that means Mr. this assessee is having this house property. Okay, he has given the possession of this house property to other assessee and he has received the possession of his house property. Okay, so the possession is received and the consideration is also received. The consideration is received in kind. You can understand exchange as kind only. Okay, because money is not transferred but the house property is transferred for house property, so it is a kind transfer. Okay, so if the possession is given and consideration is received, then even the registration is pending, it will be treated as transfer for the purpose of charging capital gain. Or I'll give you one more example. This is our assessee. Okay, he is having this house property. Okay, he has received a consideration. Okay, that means money. Okay, specifically I am saying money for house property. Okay, but the assessee who has purchased this house property has not registered this house property's title in his name. Okay, he's basically trying to avoid the stamp duty value that has to be paid to the government. Okay, so in order to avoid the stamp duty value that has to be paid to the government, the assessee who has purchased the house property is not registering the title of the house property that he has purchased. So the government says that even if it is the case, income from capital gain will be calculated and it will be considered as transferred because there is a part performance. Okay, part performance means asset is transferred, okay, plus consideration is received, okay, but only nominal registration, that is the formality of registration is pending. Okay, so just because the registration of the title is pending, it is very wrong to consider it as not transferred. That's why this section 53 came into existence, which says a possession is given and consideration is received by the assessee, and even if the registration is pending, it will be treated as transfer for the purpose of charging capital gain. I hope this is quite clear to you all. Okay, So let's understand relinquishment of capital asset. Okay, so relinquishment of the capital asset is also given on the same page. Relinquishment of the capital asset means what? Understand that if an assessee is holding shares, that is equity shares in a company, okay, so the company at times provide this equity shareholder with an option, okay, to buy the shares, okay, in advance than the normal public. Okay, so basically when the company is giving this offer to this assessee, that is the shareholders, they also give this shareholders the shares, okay, at the rate concessional price. Okay, so this assessee is receiving a right to buy more equity shares, okay, of the same company at the rate concessional rate, okay, as compared to the normal fair market value rate. I hope this is quite clear to you all. Okay, so if this assessee who has received the right of purchasing the shares at a concessional rate, and this assessee is transferring, what he is doing, he is selling. Transferring means selling his right of purchasing such shares at a concessional rate. So that is what it is given over here. So this is our shareholder, okay. The shareholder has received the right to buy the shares at the concessional rate. So what this shareholder is doing, this shareholder is transferring his right of buying the shares at a concessional rate to a person who wants to purchase this right, okay. And when this right is transferred, it is known as a renouncement, okay. So renouncement simply means transferring the right to purchase shares at the rate concessional price to someone else. So that is what it is given over here, renouncement or transfer of the right for a consideration. This shareholder is transferring his right, okay, that means he is not buying the shares of this company, okay, but since he has received the concessional price to buy this share and he does not have that much money to buy the share, for example, understand that the concessional rate is say rupees 10 and the fair market value rate is. So basically what this assessee, that is the shareholder, will do, he will sell his right for 3 rupees, okay, for rupees 3, okay, and when he sells the right for rupees 3 to this person will purchase the share for 10 rupees, that is the concessional rate, plus 3 rupees that he has paid to the shareholder. That means this third person is also purchasing the shares at a concessional rate, but the concessional rate is given by this shareholder who is already holding the share and not by the company. I hope this is quite clear, because the fair market value of the share was 15 and this third person purchased the shares at 13 rupees. That means he has purchased the shares for a discount of 2 rupees, okay, but this original shareholder has received rupees 3 per shares. So whatever this rupees 3, okay, this original shareholder has received, it will be considered as capital gain for this original shareholder, and such transfer of the right to purchase the share is also considered as transfer, that is known as relinquishment of capital asset. I hope this is quite clear. So the shareholder who is originally holding the shares of the company is known as renouncer, okay, and the person who is purchasing such a right is known as a renouncee. I hope this is quite clear. So that means the full value of consideration. FVOC stands for full value of consideration. Don't worry, we are going to study this in detail in a further part of our chapter, okay. So FVOC stands for full value of consideration. Remember that for the shareholder, that means the renouncer is renouncement price, that is rupees 3 only that he has received, okay, that is selling his rights. I hope this is quite clear to you all, okay. But cost of acquisition, that is the price at which the renouncee has purchased, okay, here it is renouncee, by mistake renouncer is written. So cost of acquisition for renouncee will be discounted share price, that is rupees 10, okay, plus renouncement price that he has paid to the shareholder, that is rupees 10 plus rupees 3, which is equal to 13. That means the cost of acquisition of the shares will be rupees 13 to this renouncee. I hope this is quite clear to you all. Okay, so we have understood relinquishment of capital asset. So let's understand extinguishment of a right in a capital asset. What does extinguishment of a right in a capital asset means? Understand that Mr. A purchases the shop. Okay, this is also a capital asset. So he is purchasing this shop from Mr. B. In order to secure this shop, Mr. A paid part amount of this shop, say rupees 10 lakh, okay, which is 50% of the consideration. Okay, that means only 50% has to be paid more, that is more 10 lakhs has to be paid. But after some time, Mr. B realized that this shop could be sold for rupees 40 lakhs. Okay, so he wants to cancel the contract between A. Okay, he wants to cancel this contract. I hope this is quite clear to you all. So in order to cancel this contract, Mr. A is saying, I won't leave this shop's possession until and unless you pay me rupees 10 lakhs plus interest on this rupees 10 lakh, as well as you have to pay me a compensation because I am letting this shop to you. So you have to pay me rupees 10 lakhs plus interest. Okay, along with this 10 lakhs you have to pay me a compensation. Okay, a compensation of rupees 10 lakhs. So whatever this rupees 10 lakhs have been received by this Mr. A, it is considered as Mr. A is having a right on this shop. Okay, so in order to extinguish this right on the shop, he has received rupees 10 lakhs compensation. Okay, so this 10 lakhs compensation will be considered as capital gain of Mr. A. Okay, because Mr. A has transferred his right in this shop to Mr. B again. So that's why it is known as extinguishment of right in a capital asset, because Mr. A was having a right in this shop and this shop was the capital asset. Okay, and he has developed a right due to a contract between Mr. A and Mr. B, but Mr. B is not honoring the contract and he wants to cancel the contract. Okay, since Mr. B is cancelling the contract with Mr. A, Mr. A has demanded a rupees 10 lakhs compensation in order to extinguish, that means in order to give up his right on this shop. I hope this is quite clear. So extinguishment of right in a capital asset simply means you have developed a right on this capital asset and you are giving up. Okay, and you are giving up the right on this capital asset. So by giving up this right on the capital asset, what you are receiving? You are receiving a consideration. Okay, since you are giving up, in order to receive a consideration, it will be considered as a transfer. I hope this is quite clear to you all. Okay, so the next point is compulsory acquisition of capital asset. I have already explained you what does compulsory acquisition of capital asset means, and as well as I have also explained you what does conversion of capital asset into stock in trade means. Okay, here you can study exchange of capital asset. Okay, I hope this is quite clear. So our page number 1 of the notes and page number 2 are completed. Okay students, so now let's understand types of capital gain. There are two types of capital gain, that is long term capital gain and short term capital gain. So how to identify whether an SAC has earned a long term capital gain or has earned a short term capital gain? Because how things will get triggered is, there is a capital asset and this capital asset is sold, that is transfer. Okay, and after such transfer the assessee will calculate the capital gain, and then we have to identify whether such capital gain is a long term capital gain or such capital gain is a short term capital gain. I hope this is quite clear. So how to identify that, let's understand over here. There are three ranges: 12-month range, 24-month range and 36 months range. Okay, in this 12-month range there are three kinds of capital assets. Okay, so let's understand that. First is listed shares on recognized stock exchange. STX stands for stock exchange. Then second capital asset is unit of equity oriented fund or unit of UTI. UTI stands for Unit Trust of India. And third capital asset is zero coupon bond. So understand this, if an assessee, okay, holds any of the capital asset, CA stands for capital assets over here, out of this 12 months range, and such capital asset is holded for a period more than 12 months, then any capital gain derived on this kind of capital assets will be considered as long-term capital gain. I hope this is quite clear. But similarly, if any of this asset, for example, understand that if listed shares of a recognized stock exchange is holded for 9 months by an assessee, and after 9 months such listed shares are transferred, okay, on such transfer the assessee will earn a capital gain. So what this capital gain is, whether it is long term capital gain or whether it is short term capital gain, since it is holded by the assessee for a period of 9 months, it will be short term capital gain. But instead, this listed shares of a recognized stock exchange was holded for 12 and a half months, okay, which is more than 12 months, okay, then any capital gain arrived on this capital asset will be considered as long term capital gain. So basically what you need to remember is, you need to remember the range and the assets that are given under such range. I hope this is quite clear. So we have studied this 12-month range, okay. If any assessee hold any of these assets for a period of more than 12 months, okay, then any capital gain arising on any of this capital asset will be long term capital asset. I hope this is quite clear. But similarly, if the assessee, okay, has holded any of the securities out of this 12-month range and such security is holded for a period of less than 12 months, then also it will be considered as short term capital gain if an assessee has incurred a capital gain on such sale or such transfer of this capital asset. I hope this is quite clear to you all. Okay, so now let's understand 24 months range. Okay, so which all capital assets are included in this range? First capital asset is unlisted shares, and second capital asset is land or building or both. Building means house property, shops, okay, etc. I hope this is quite clear to you all. So in this 24 months range, if an assessee, okay, if this assessee is holding a unlisted shares for a period of 23 months, okay, which is less than 24 months, and on such transfer, okay, on such transfer of this unlisted share, the assessee has gained a capital gain. So what is this capital gain? This capital gain will be short term capital gain, because the period of holding of this unlisted share is 23 months, which is less than, okay, which is less than 24 months. I hope this is quite clear. But similarly, if this unlisted share was holded for a period of more than 24 months, for example, understand that 25 months, okay, then the capital gain arrived on this unlisted share due to transfer, okay, due to transfer, will be considered as long term capital gain. I hope that is quite clear. Similarly goes for land and as well as for building, or for both also, okay. So that means we need to always remember the period, okay, as well as the capital asset belonging to that period, okay. This is the range. I hope this is quite clear to you all. So let's understand our last range, that is 36 months range, okay. So the capital assets given under this 36 months range is units of debt oriented funds, and second capital asset given under this 36 months range is unlisted securities other than shares, and third capital asset given under this 36 months range is any other capital asset other than this, okay, other than whichever we have studied above. I hope this is quite clear to you all. So if an assessee, okay, holds this units of debt oriented fund for a period of 33 months, okay, and at the end of this 33 months the debt oriented funds are transferred, okay, and the assessee has earned a capital gain. So this capital gain will be what? Short term or long term? This will be short term capital gain. Why? Because the period of holding is 36 months, but the period of holding if more than 36 months, then it would have become long term capital gain. I hope this is quite clear to you all. So that is what this chart is representing, okay. Long term capital gain can be ascertained only if the period of holding is more than 12 months more than 24 months, more than 36 months after seeing the capital asset. I hope this is quite clear. So that's why the range as well as the capital assets details are given below. I hope this is quite clear. Similarly, it goes for short-term capital gain. There are three periods of holding, that is less than 12 months period of holding, less than 24 months period of holding, less than 36 months period of holding. So basically what we need to identify is we need to identify a particular capital asset first of all, and we need to identify that such capital asset falls in which range. Okay, after identifying that, we need to identify the period of holding. POH stands for period of holding. So after identifying the period of holding, we can ascertain that if it is more than 12 months, okay, then it is a long term capital gain. But if it is less than 12 months, okay, then it is a short term capital gain. I hope this is quite clear to you all. So let's revise this range again, okay, and then this types of capital gain is done, because this is just a beginning. Okay, once we complete the entire capital gain chapter, we will once again revise the entire chapter in 15 to 20 minutes. Only after that you will come to understand this, because capital gain is a easy chapter. But when you are studying it for the first time, things will become little difficult for you all, because you are studying it for the very first time. Okay, in 12 months range, there are three capital assets, that is listed shares on recognized stock exchange, units of equity oriented funds, or units of UTI, or zero coupon bonds. Okay, under 24 months range, there are two types of capital asset, that is unlisted shares, land or building, or both. Okay, and in 36 months range, there are three types of capital asset, that is units of debt oriented fund, unlisted securities other than shares, other capital asset. I hope this is quite clear. Okay students, so here are few examples given on this page in your notes. Okay, so there are four examples given on this page. The very first example tells us that Mr. Radhe has a house property, okay, which is a capital asset, and Mr. Radhe has purchased such house property in the financial year 2005 and 6 for rupees 12 lakh. So basically the cost of the house property purchased by Mr. Radhe is rupees 12 lakhs. I hope this is quite clear, and this 12 lakhs is also known as cost of acquisition. Then the next point says that Mr. Radhe sold this house property for rupees 65 lakhs in the previous year 2019-20. Okay, so this is the actual consideration at which the house property is sold, and then there is a detail of stamp duty value of such house property. In case 1 it is 70 lakhs, in case 2 it is 67 lakhs, in case 3 it is 60 lakhs. So in exam all these three details will not be given, any one of the detail will be given. So in order to explain you some concepts, I have taken three examples over here. First example is 70 lakhs, second is 67 lakhs, and third example is 60 lakhs. I hope this is quite clear. And the transfer expenses, that means brokerage, is 5%. Okay, and the example is asking us to calculate capital gain on such transfer of capital asset and calculate tax on the same. Okay, so basically with the help of this example we will understand concepts like section 50C, okay, as well as transfer expenses. What does transfer expenses means? Okay, in this section 50C, what we will understand is what does full value of consideration means. I hope this is quite clear to you all. Okay, and we will understand the format. Okay, directly if we understand these concepts, things will become little confusing for you all. So I have decided to explain you with the help of example. I hope this is quite clear. So let's read this example once again. Mr. Radhe has a house property. Okay, basically this house property is a capital asset, as we have studied under section 2 subsection 14. I hope this is quite clear. And we have also studied types of capital gain. There are two types of capital gain: long term capital gain and short term capital gain. In that chart we have studied ranges. Okay, and this house property specifically falls under 24 months range. I hope this is quite clear to you. Then the next detail given in the question is Mr. Radhe has purchased such house property in the financial year 2005 and 6 for rupees 12 lakhs. I hope this is quite clear. So here we will also study cost of acquisition. What does cost of acquisition mean? Okay, and we will also study indexation. What does indexation means? I hope this is quite clear to you all. Then the next point in the question is Mr. Radhe sold this house property for rupees 65 lakhs in the previous year 2019-20. I hope this is quite clear. So the difference between the cost of acquisition and the actual consideration received will become our capital gain. But this is not the case. How to calculate the capital gain we will study in our format book. It is not simple that 65 lakhs is the consideration that we have received and 12 lakhs is the cost. So the difference between these two, that is 53 lakhs, will become our capital gain. So the answer is no. How to calculate the capital gain we will study in the format book, so don't worry about that. Then the next point in the question is stamp duty value of such house property. There are three examples of the stamp duty value: 70 lakhs, 67 lakhs, 60 lakhs. In each of this case, we need to calculate the capital gain for this house property. I hope this is quite clear to you all. Then the transfer expenses details are given. And with the help of this point, we will understand transfer expenses. What does transfer expenses means? I hope this is quite clear to you all. And finally, we will learn how to calculate capital gain on such transfer of capital asset and to calculate tax on the same. I hope this is quite clear. So let's come into the format book. Okay, so these are the basic details we have already seen in the earlier chapters also, but the new detail that we are seeing over here is a period of holding, and here is a capital asset. So let's feed the detail in this format. Name of the assessee is Mr. Radhe. Okay, residential status not given, so we will assume resident, ordinary resident. Capital asset is house property. Okay, so we need to ascertain the period of holding first of all. So since we can see in the question that the asset was purchased in the financial year 2005 and 6, and the asset is sold in the previous year 2019-20, and this house property falls in the range of 24 months. I hope this is quite clear. Since you can see that the period of holding is from the financial year 2005 and 6 to the financial year 2019-20. So it can be simply ascertained that the period of holding is more than 24 months. I hope this is quite clear. So in place of period of holding, we will write over here as more than 24 months. I hope this is quite clear. So that means that our asset, that is the house property, is a long-term capital asset. Okay, so which format we will use to calculate the capital gain? We will use this format, that is computation of long-term capital gain format, so that we can calculate the long-term capital gain. But for example, if this house property would have been short-term capital asset, then we would have not used this format. We would have used this format which says computation of short-term capital gain. I hope this is quite clear. So this format you are seeing is specifically for other than listed equity shares. I hope this is quite clear. And there is a format specifically for listed equity shares on the next page. I hope this is quite clear to you all. So the very first thing that is given in this format is we need to identify full value of consideration. So what does full value of consideration means? In layman terms, understand that full value of consideration is the amount at which capital asset is sold. I hope this is quite clear. But since our capital asset is a house property, there is a specific section given under the income from capital gain, that is section 50C. Okay, this section 50C helps us to calculate full value of consideration specifically for house property, land slash building. I hope this is quite clear to you all. So in order to calculate the full value of consideration, we need to understand section 50C. So let's come back to our notes. Okay, on the next page over here you can see section 50C, full value of consideration. How to calculate full value of consideration? So section 50C says that full value of consideration in case of a land and building. Okay, so house property basically forms part of building only. I hope this is quite clear. We have studied income from house property. There we have studied what does building means. I hope this is quite clear to you all. Okay, so full value of consideration in case of land and building or both will be calculated in this manner. If stamp duty value, okay, if stamp duty value is more than 105% of the consideration actually received, 105% of the actual consideration received, then the full value of the consideration will be equal to stamp duty value. So basically what is this stamp duty value? Stamp duty value is a value of house property as derived by stamp duty valuation authority. I hope this is quite clear to you all. So this stamp duty value we have to consider in order to calculate full value of consideration of the house property. I hope this is quite clear to you all. Okay, so let's understand it from the start again. Section 50C says that full value of consideration in case of a land and building or both will be calculated in this manner. If stamp duty value is more than 105% of the consideration actually received, then full value of consideration is equal to stamp duty value. I hope this is quite clear. Otherwise, that means if the stamp duty value is less than 105% of the consideration actually received, then the full value of consideration is equal to actual consideration received. I hope this is quite clear. So this much part is important for our example. I hope this is quite clear. and this remaining part we will understand it in the next example. Okay, so firstly we need to have a grip over this. What is this? I hope this is quite clear. So in the question, 65 lakhs is the actual consideration given to our SSC Mr. Radhe. I hope this is quite clear. And the stamp duty value of such house property as derived by the stamp duty valuation authority is given. There are three cases, that is, in first case it is 70 lakhs, in second case it is 67 lakhs, in the third case it is 60 lakhs. I hope this is quite clear. So our primary thing in our format right now is to find out full value of consideration. I hope this is quite clear to you all. So let's calculate full value of consideration. Okay, so let's come back to the notes. Okay, and we will calculate full value of consideration over here only. Okay, so full value of consideration, the formula says that stamp duty value will be compared with 105% of actual consideration. I'm writing AC over here, that means actual consideration. Stamp duty value in case 1 is given 70 lakhs, so we will write over here simply 70 lakhs, and we will calculate 105% of 65 lakhs. I hope this is quite clear. So we will write over here 105% of 65 lakhs. I hope this is quite clear. So let's calculate 105% of 65 lakhs. 65 lakhs into 105%, which is equal to 68 lakhs 25,000. I hope this is quite clear. So as you can see that 70 lakhs is more than 68 lakhs 25,000. I hope this is quite clear to you all. So that means the stamp duty value is more than 105% of the actual consideration. So therefore, full value of consideration will become the stamp duty value, which is equal to 70 lakhs. That is what we have studied in this section 50C. I hope this is quite clear. If full value of consideration is to be calculated in case of a land and a building or both, then if stamp duty value is more than 105% of the actual consideration received, so in our case the stamp duty value was 70 lakhs and 105% of the actual consideration was 68 lakhs 25,000. So 70 lakhs is more than 68 lakhs 25,000. Then the full value of consideration is stamp duty value, which is 70 lakhs. I hope this is quite clear to you. So in our format book over here, we will take 70 lakhs as full value of consideration. I hope this is quite clear. And then we will reduce transfer expenses. So what does transfer expenses mean? And is there any transfer expenses given in the question? The answer is yes, there is a transfer expenses given in the question. So what is a transfer expense? The transfer expense is 5%, that is brokerage. So basically we need to understand what this transfer expenses means. So where we have studied section 50C, below that there is transfer expenses. What does transfer expenses means? Transfer expense is the expense incurred in connection with transfer of capital asset. Which asset? Capital asset. I hope this is quite clear. Example of transfer expenses is registration fees, brokerage, stamp duty paid by the owner of the capital asset will be allowed to be reduced from the full value of consideration, that is full value of consideration minus transfer expenses, and finally we will get net consideration. I hope this is quite clear. So which all transfer expenses can be allowed to be reduced from full value of consideration, that is registration fees, brokerage, stamp duty, etc. And other example is amount paid to the tenant to vacate the property due to a clause in the agreement is also a valid expense for transfer expenses. So what does this mean? Understand that this is our assessee. Okay, he has given his house property to a tenant. I hope this is quite clear. And there is a lease period of say 2 years. Okay, and there is a clause in the agreement that if the owner wants to sell this house property, okay, and such house property he wants to sell before the lease period, okay, before the lease period of 2 years, then this means that the owner is cancelling the contract or the agreement between the owner and the tenant. I hope this is quite clear. So since he is cancelling the contract, he has to pay some compensation to the tenant so that he can vacate. That means he can leave the house property. I hope this is quite clear. So if there is a clause in the agreement, then only such expenses, that means the amount paid by the owner to the tenant to vacate, that means to leave the house property, will be allowed as a valid transfer expense. I hope this is quite clear to you all. And STT paid is not allowed. So what does this mean? We will understand it when we will study the capital asset, which is equity shares. I hope this is quite clear to you all. So be patient for that. I hope this is quite clear. So in the question has provided us the detail of transfer expenses. So the transfer expenses is a brokerage and transfer expenses is 5%. So how much is the transfer expenses in monetary terms? We need to calculate that. So on which this 5% will be calculated? This 5% will be calculated on full value of consideration or on actual value of consideration. So the answer is this 5% will be calculated on actual consideration, because a brokerage is paid on actual value of consideration. So do not confuse yourself with full value of consideration as an actual consideration, because many of the times I have seen students making this mistake. They calculate full value of consideration, okay, which is higher than the actual consideration, and they calculate the brokerage on this full value of consideration. I hope this is quite clear. So do not make this mistake. Always calculate the brokerage on the actual consideration. I hope this is quite clear to you. So let's come back to our format over here and let's write it over here. 5% of 65 lakhs. I hope this is quite clear. So let's see how much it will be. 65 lakhs into 5% is equal to 3 lakh 25,000. I hope this is quite clear. So this is the transfer expenses, and our finally net consideration will be equal to minus plus 70 lakhs is equal to 66 lakhs 75,000. I hope this is quite clear to you all. So the next thing given in this format is less index cost of acquisition. I hope you all have already understood what this cost of acquisition means. So let's understand indexation on a new page. What does index cost of acquisition means? Okay, so simply understand that a particular property is purchased in previous year 2005 and 6 for rupees 12 lakhs. I hope this is quite clear to you all. And this property is sold in previous year 2019-20, okay, for rupees 65 lakhs. I hope this is quite clear. So what does indexation means? Indexation simply means that the cost of rupees 12 lakhs which was incurred in the financial year 2005 and 6, we are going to bring this cost at par with the previous year, that is the financial year 2019-20. So how we will do that? So the formula says that, let's come into the format book. The index cost of acquisition formula says that actual cost of acquisition, that means 12 lakhs, into index cost of inflation for the date of transfer divided by the index cost of inflation of the year of acquisition. So what does index cost of inflation means? We need to understand it in the study material. So come in your study material on page number 4.398. okay, over here the cost inflation indices for the financial year so far has been notified and has been given. Okay, so basically our asset was sold in the previous year, that is the financial year 2019-20, and the cost inflation index value is given as 289. I hope this is quite clear. So this will become our numerator. So that is what we have studied in this formula, which says that here we will mention actual cost of acquisition, that is 12 lakhs, and over here in the numerator we will feed the index cost of inflation for the date of transfer. So the actual transfer has took in the financial year, that is the previous year 2019-20. So the index cost of inflation value is given as 289. okay, and the actual asset was purchased in the financial year 2005 and 6, and the index cost of inflation is 117. I hope this is quite clear. So let's come into our blank page and let's calculate index cost of acquisition. So it is equal to 12 lakhs, okay, into 289. That means the index cost of inflation for the date of transfer. So the index cost of inflation for the date of transfer is 289, and the transfer took place in the previous year 2019-20. Similarly, it will be divided by the index cost of inflation of the year in which the asset was actually purchased, that is 2005 and 6, and the index cost of inflation for the year 2005 and 6 is 117. okay, so after calculating this equation we will get the index cost of acquisition. So let's calculate this equation. 12 lakhs into 289 divided by 117. I hope this is quite clear. So finally we derive a figure of 29 lakhs 64,103. So basically what we have derived is, we have derived this 12 lakhs cost which was incurred in the previous year 2005 and 6. We have brought this 12 lakhs cost at par to the previous year 2019-20. I hope this is quite clear. So in simple words, we can say that this 12 lakhs was incurred in the previous year or the financial year 2005 and 6. So basically, if this cost would have been incurred in the previous year 2019-20, then the cost of this 12 lakhs would have been 29 lakhs 64,103. I hope this is quite clear. That is what we have calculated over here. I hope this is quite clear to you all. So in the format book, okay, we will come in this format, okay, computation of long-term capital gain, and in place of index cost of acquisition, we will feed that detail. So let's mention that figure over here, 29 lakhs 64,103. Okay, this will be reduced. So the question does not provide us any detail of cost of improvement over here. Okay, so we will put a dash over here in place of index cost of improvement. I hope this is quite clear. After calculating this, we will get a gross long-term capital gain. So how much is the gross long-term capital gain? Let's calculate that. Minus plus 66 lakhs 75,000, which is equal to 37 lakh 10,897. I hope this is quite clear. So question does not give us any detail about the exemption under section 54 to 54 GB. Okay, so we have already studied there is no exemptions detail given under section 54 to 54 GB, and any which ways we need to study this concept altogether. So for simplicity, I have not taken any exemption in our first example. I hope this is quite clear. So we'll put a dash over here, and finally our long-term capital gain is equal to 37 lakh 10,897. Okay, 897. So the question was simply asking us to calculate the capital gain on such transfer of the capital asset. So that is what we have done. And what else the question has asked us? The question has asked us to calculate the tax on the same. So let's come back to the format book again. So how much is the tax rate? Okay, so understand this now. Okay, so basically, if a capital asset is a long-term capital asset and such capital asset is other than the listed equity shares, I hope this is quite clear, then if such long-term capital gain is calculated with a method of indexation, okay, then the final long-term capital gain derived on such capital asset, that is the house property, then whatever amount of long-term capital gain has been derived, it will be taxable at the rate of 20% flat. I hope this is quite clear. So the rate of tax in this case is 20%. I hope this is quite clear to you. So let's calculate that. The tax on 37 lakhs 10,897 is 7 lakhs 42,179. I hope this is quite clear to you all. So basically you can see that if an assessee who has a capital asset and such capital asset is a long-term capital asset other than the listed equity shares, then if he follows the index cost method, okay, index cost method, then whatever capital gain has been derived, it will be taxable flat at the rate 20%. What if the assessee who is having a capital asset and such capital asset is a long-term capital asset other than a listed equity share does not want to follow the indexation method, then what will be the tax rate? So that is what is given in the note. If long-term capital gain is calculated and the index method is not opted, that is the indexation method has been not opted, then the tax will be at the rate 10% flat. That means whatever long-term capital gain will be derived over here, it will be taxable at the rate 10%. So that's why there are two columns over here. The first column is for indexation and the second column is for not indexation. I hope this is quite clear to you all. So we will calculate the long-term capital gain without indexation. I hope this is quite clear to you all. So the full value of consideration will be same. The transfer expenses will also be same. The net consideration will also remain same, 66 lakhs 75,000. What will change over here is we will not write index cost of acquisition, we will write cost of acquisition because we are following a method without indexation. I hope this is quite clear to you all. So basically this is without indexation method. So here we will simply feed the actual cost of acquisitions detail, which was 12 lakhs. I hope this is quite clear. There are no details about cost of improvement, so we will put a dash over here. And finally we will get a gross long-term capital gain. So we need to calculate gross long-term capital gain because it won't be same like this with indexation method. Okay, so 66 lakhs 75,000 minus 12 lakhs is equal to 54 lakhs 75,000. So let's feed that detail. 54 lakhs 75,000. I hope this is quite clear to you all. And there are no exemption detail given in the question. So the final long-term capital gain is 54 lakhs 75,000. I hope this is quite clear. And the tax will be equal to 5 lakh 47,500. I hope this is quite clear to you all. So if you can see why I have made a comparison over here, because in the exam you have to also make this comparison. I hope this is quite clear to you all. Okay, because you can see that in case when without indexation method is followed, okay, then the final tax liability is lower as compared to the index cost of acquisition method. So if the question also asks us which method to be followed, so we will simply specify that without indexation method should be followed since the tax liability is lower. I hope this is quite clear to you all. So here with the help of this example number 1, which all concept we have studied this section 50C's this much part. Okay, up to here we have studied what does transfer expenses means. We have also studied what does indexation means, okay, and when to follow the indexation, and what will be the tax rate if the indexation is followed, and what will be the tax rate if indexation is not followed. So it is simple that if indexation is followed, then the tax rate is 20%, and if the indexation is not followed, then the tax rate is 10%. So let's come into the notes. Okay, over here we can see that there are rates of taxes given in case of capital gain. There are two types of rates of taxes. First is rates of taxes in case of equity shares, and second is rates of taxes in case of any other capital asset other than equity shares. So basically our house property falls in this category, that is any other capital asset other than equity shares. Okay, so the rates of taxes are given over here. The rates of taxes are as follows. Long-term capital gain, if calculated with indexation method, then the tax rate is flat 20%. But if the long-term capital gain is calculated without indexation method, then the rate of tax is flat 10%. But if the short-term capital gain is calculated on any other capital asset other than equity shares, then the rates of taxes is the slab rate. Okay, in case of an individual, the slab rates we have already studied, but in case of a firm, the slab rate is 30%. Okay, in case of a company, the slab rate is also 25% or 30% as the case may be. Okay, but in your case or in your level, the slab rate will be simply for individual only, because the capital gain questions will be asked from the point of view of a person only, that is an individual. So do not worry about the slab rates for any other kind of assessee like firm, company. I hope this is quite clear to you all. So with the help of this first example, we have understood a lot of things. Okay, but we have solved this question considering stamp duty value of such house property as 70 lakhs. Now we will solve the question considering the stamp duty value of such house property as 67 lakhs. Okay, so over here we will simply change the detail stamp duty value as 67 lakhs. Okay, and over here also we will change the detail as 67 lakhs. Okay, 105% of the actual consideration, that is 65 lakhs into 105% will remain same, that is 68 lakhs 25,000. So as you can see that 67 lakhs is less than 68 lakhs 25,000. So that means that our full value of consideration will be equal to actual consideration, which is equal to 65 lakhs. That is what we have studied in our section 50C. Section 50C says that full value of consideration in case of a land and building or both, okay, will be calculated in this manner. If stamp duty value is more than 105% of the consideration actually received, then the full value of consideration is stamp duty value. But otherwise, that means stamp duty value is less than 105% of the consideration actually received, then the full value of consideration will be equal to actual consideration received. So in our example number 1, the actual consideration received is 65 lakh. So that means full value of consideration will be 65 lakhs. I hope this is quite clear to you. So let's move back into format and let's change the figures and see. Okay, so our full value of consideration over here will change to 65 lakhs. Let's feed that detail over here as 65 lakhs. Okay, and our net consideration will also change our net consideration will be equal to 61 lakhs 75,000. I hope this is quite clear to you all. Over here also, without indexation method also, it will be same only 61 lakhs 75,000. Okay. And further, the net consideration will be reduced by the index cost of acquisition or the cost of acquisition in case where the indexation method is not followed. The index cost of acquisition will remain same only because the cost of acquisition is 12 lakhs only and the asset is any which was sold in the year 2019-20 only, and the actual cost of acquisition year is also 2005 and 6 only, so this figure will not change and the cost of acquisition will be same only when indexation is not opted. I hope this is quite clear to you all. So the final gross long term capital gain figures will change, so let's change that. Okay, and finally our tax liability will also change, so let's erase this and let's find all these details. Okay, so our gross long-term capital gain in case when indexation is followed, 61 lakh 75,000 minus 29 lakh 64,103 is equal to 32 lakhs 10,897. Okay, 32 lakhs 10,897 is our long-term capital gain. On this long-term capital gain, 20% will be calculated and the tax will be equal to 6 lakhs 42,179. I hope this is quite clear to you all. Okay, now let's calculate the gross long-term capital gain in case when indexation method is not followed. So let's calculate that. 61 lakhs 75,000 minus 12 lakhs is equal to 49 lakhs 75,000. Okay, on this 49 lakh 75,000, which is our long term capital gain, tax will be calculated at the rate 10%, which is equal to 4 lakh 97,500. I hope this is quite clear. Since you can see in this case also, again the final tax liability is lower as compared to when the indexation method is followed. So simply the assessee, that is Mr. Radhe, will follow a method without indexation. So let's move back into the notes and let's solve the question considering the stamp duty value of such house property as 60 lakhs. So over here, stamp duty value we will write as 60 lakhs. Okay, and we will compare it with the 105% of the actual consideration. So as you can see that 60 lakhs is also lower than this 68 lakhs 25,000. Okay, so the full value of the consideration will be actual consideration only, that is 65 lakhs. So the solution that we have already written will remain same only. If you want to copy, you can copy it, but I'll advise do not copy, solve it on your own because it will help you. Okay, so let's revise the concept that we have studied with the help of this particular example. We have studied this section 50C. Section 50C says that full value of consideration in case of a land and building or both will be calculated in this manner. If stamp duty value is more than 105% of the consideration actually received, then the full value of the consideration is the stamp duty value. Otherwise, that means stamp duty value if less than 105% of the actual consideration received, then the full value of consideration is the actual consideration received. Okay, and not 105% of the actual consideration received, because many of the time students do mistake, so please avoid that mistake. Okay, what does transfer expense means? Transfer expense is the expense incurred in connection with the transfer of the asset. Which asset? Capital asset. Example of transfer expenses is registration fees, brokerage, stamp duty, etc. paid by the owner of such capital asset. Okay, amount paid to the tenant to vacate the property due to a clause in the agreement is also a valid expense for transfer expense. I hope this is quite clear to you. And we have studied indexation in the format book. Let's come at the bottom of this two table. What does index cost of acquisition means? Index cost of acquisition means actual cost of acquisition into index cost of inflation for the date of transfer divided by index cost of inflation of the year of acquisition. I hope this is quite clear. So basically, with the help of this index cost of acquisition, what we are doing is we are bringing this actual cost of acquisition at par to the year in which the asset has been actually transferred. I hope this is quite clear to you all. And what else we have studied? We have studied the rates of taxes. So let's come into the notes again. Over here in the rates of taxes, we have studied this part. Okay, so let's revise this part. If the asset is a capital asset and such capital asset is other than the equity shares, then the rates of taxes will be as follow. If the long-term capital gain is calculated with indexation, then the tax will be calculated on this long-term capital gain at the rate flat 20%. But this long-term capital gain is calculated without indexation method. Then the tax on this long-term capital gain will be calculated at the rate flat 10%. I hope this is quite clear to you all. Similarly, if the short-term capital gain is calculated on any other capital asset, which is any other capital asset other than equity shares, that is listed equity shares, then the short-term capital gain will be taxable as per the slab rates that we have already studied. I hope this is quite clear to you. Okay students, so we have already solved this example number 1. So now let's start with example number 2. Example number 2 is basically an extension of this example number 1 only. So let's read the question. Okay, we'll just simply read the question and then we will decide what has to be done. Okay, Mr. Radhe has a house property which is a capital asset. Okay, Mr. Radhe has purchased such house property in the financial year 2005 and 6 for rupees 12 lakh. Mr. Radhe did renovation to such house property in the financial year 2010-11 at the rate rupees 10 lakh. So this is a new part, okay, in this example number 2. And then the next part in the question is Mr. Radhe sold this house property for rupees 65 lakhs in the previous year 2019-20. This is same only that we have already solved in example number 1. Then stamp duty value of such house property, and there are cases, okay, 70 lakh in first case, 67 lakh in second case and 60 lakhs in third case, okay. And the value as per valuation officer, VO stands for valuation officer. In case 1 it is 72 lakhs, in case 2 it is 66 lakhs and in case 3 it is 64 lakhs. So what is this? Basically this part is the remaining part of section 50C, okay. So let's come into section 50C. This part was remaining, right? We have completed this much part, okay, and we have not completed this part. So this remaining part we will understand with example number 2. I hope this is quite clear to you all. So let's come back to the example again. And what the question is finally asking us to do, the question is finally asking us to calculate capital gain on such transfer of capital asset. Here in this question, the question is not asking us to calculate the tax liability on such capital gain. I hope this is quite clear to you all. And the next part in the question is Mr. Radhe wants professional advice from you as a tax advisor that how to save the tax on such capital gain. So basically here section 54 to 54 GB triggers, okay. So before solving this sum and before understanding this remaining part of section 50C, we will understand this section 54 to 54 GB, okay. So let's come to this page where exemptions are given under section 54 to 54 GB. I hope this is quite clear. So we will understand this table, okay, and then we will understand our example number 2. I hope this is quite clear to you all. So here section 54 is given, okay. So we will read each of the section in a column manner, okay. I hope this is quite clear to you all. So our first column is section 54, okay. So what does this section 54 column say is that if an assessee is there, okay, and such assessee is an individual or HUF, okay, and such individual or HUF is having a property that is a capital asset which is a residential house property, okay, and such residential house property is transferred by this individual, okay, and such residential house property is a long-term capital asset. What does long-term capital asset means? We need to understand that firstly this residential house property falls in 24 months range, okay. So in order that this residential house property can be a long-term capital asset, this residential house property should be held by this individual for more than 24 months. I hope you agree with this, okay. So let's read up to here again. So section 54 says that if there is an assessee and such assessee is an individual or HUF, okay, and such individual HUF transfers a residential house property that is a capital asset and such residential house property is a long-term capital asset, and after transfer of such residential house property which is a long-term capital asset, a new asset is acquired by this individual or HUF, and the new asset that is acquired, that is a capital asset that is acquired by this individual or HUF is one residential house property in India or two residential house properties acquired in India only when capital gain does not exceed rupees 2 crore. So this second point is a complete point, okay. This last part does not exceed rupees 2 crore is not a common point for this point number 1 and point number 2. So let's read it again. If the assessee, that means our individual HUF, purchase a new asset that is one residential house property in India or two residential house property acquired in India only when capital gain does not exceed rupees 2 crore, then the amount of exemption available to this individual or HUF under section 54 is gross long-term capital gain, okay, or the amount invested in this new asset acquired. I hope this is quite clear. Whichever will be lower of this two, that is gross long-term capital gain or the amount invested in this new capital asset, okay. then it will be allowed as exemption under section 54. I hope this is quite clear. The time limit is important. Okay, the time limit within which the assessee can invest the amount in this new capital asset is if the new residential house property is purchased, then if this is the date, that is 1st April 2019 is the date of selling of the old residential house property. But even if before the sale of this old residential house property, if the assessee has purchased a residential house property before 1 year, okay, exactly before 1 year from the date of sale, that is 1st April 2019, then also whatever amount has been invested in this residential house property before the date of the sale, that is up to 1 year before the transfer date, then that amount which has been invested in this residential house property will be allowed as exemption under section 54. I hope this is quite clear. But if the date of transfer is 1st April 2009 and after the date of transfer the new asset is acquired within 2 years, okay, within 2 years, then such investment in this new capital asset within 2 years will be allowed as exemption under section 54. Okay, that amount will be taken over here as amount invested. I hope this is quite clear. But what if the asset is sold on 1st April 2009 and after the sale of asset within 3 years the asset, that is the residential house property, is constructed? So if constructed within 3 years after the transfer date, if the amount is invested, even that will be allowed as exemption under section 54. I hope this is quite clear. So this is quite a flexible limit given by the Income Tax Act, that if an assessee sells a house property, okay, so it is not very easy to find immediately a next house property. I hope this is quite clear to you. So that's why 2 years time is given in case of purchase. But if the house property is constructed, maximum within 3 years, the house property can be constructed after the date of transfer. I hope this is quite clear. But many of the times it is a possibility that the assessee is very unsure that first he wants to find a new property, okay, new residential house property, and once he has found this residential house property, then only he will sell off his old residential house property. So that's why the time limit is given of 1 year before the date of transfer, that is 1/4/2019. I hope this is quite clear. So I hope you have understood this time limit also. Okay, and the next point is the lock-in limit. Okay, so once the assessee has purchased this new asset after the transfer of this old asset, okay, then such new asset cannot be sold or transferred within a period of 3 years. Okay, for example, understand this. This is a residential house property which the assessee has acquired, that is newly asset acquired after the transfer of the old residential house property. Then this new residential house property cannot be transferred within 3 years. I hope this is quite clear. Only after 3 years this house property can be transferred. I hope this is quite clear. But if the assessee makes a violation of this lock-in period, then what will happen? The new house property, okay, the new house property which is sold, okay, we will find out its full value of consideration, okay, and then we will reduce transfer expenses, and then we will find out our net consideration. I hope this is quite clear. And from this net consideration we will reduce cost of acquisition. Okay, so for example, the new house property was acquired for 1 crore, okay, and earlier the exemption under section 54 was availed of rupees say 50 lakhs. I hope this is quite clear. So whatever the exemption was earlier availed of 50 lakhs will be reduced from this cost of acquisition of the new residential house property, and the cost of acquisition will become 50 lakhs only. I hope this is quite clear to you. So if the assessee violates the lock-in period, then the violation's punishment is in this manner. Exemption claimed earlier should be reduced from the cost of acquisition of new asset. That is what we have understood over here. I hope this is quite clear to you all. So basically the violation is similar for all these three sections, that is section 54, section 54B and section 54D. I hope this is quite clear. So let's revise this section 54 once again. Okay, so understand it in this manner. Okay, if an assessee is there, okay, understand it taking your example, your own example, that you are an individual, okay, and you are having a residential house property, okay, and you are thinking to transfer this residential house property which is a long-term capital asset, okay, and you don't want to pay a capital gain tax on this capital gain that you have earned on this residential house property that has been transferred. I hope this is quite clear. So what you do is, whatever the consideration you have received from the sale of this old residential house property, you use it for the purchase of new asset, that is one residential house property in India of any value, or to residential house property acquired in India only when capital gain does not exceed rupees 2 crore. So it does not matter the value of the house properties. Okay, the matter is if the capital gain exceeds 2 crores, then you cannot buy two residential house property. But if the capital gain does not exceed 2 crore, then you can purchase two residential house property, and that two residential house properties value will be allowed as exemption under section 54. Okay, after applying this formula. I hope this is quite clear to you all. So basically what is done by this individual who has transferred his residential house property, which is a long-term capital asset, he has purchased one more residential house property in India. Okay, for example, understand this, the residential house property earlier which is sold is of 1 crore. Okay, this is the full value of consideration. I hope this is quite clear. And after considering everything, that is index cost of acquisition and all, gross long-term capital gain comes to around 50 lakhs. So what does this assessee thinks on this 50 lakhs? If he has to pay tax, he has to pay tax at the rate 20% because indexation has been followed. That means a tax of rupees 10 lakhs has to be paid. So instead what he thinks is, I don't want to pay the tax on this 50 lakhs. I'd rather purchase a new capital asset which is a residential house property in India only as per section 54, and then the exemption will be allowed in this manner, that is gross long-term capital gain is of rupees 50 lakhs. I hope this is quite clear that we have earlier only studied, and the amount invested in this new residential house property is say again 1 crores only. Okay, so this 50 lakhs and the 1 crore will be compared, and whichever will be lower of this two, that is 50 lakhs will be lower, then this 50 lakhs will be allowed as exemption under section 54. I hope this is quite clear to you all. The time limit for purchasing of this residential house property in India is, if purchased 1 year before the transfer date, the house property can be purchased, and whatever amount has been invested in this new house property can be allowed as amount invested. Okay, and it will be compared with this gross long term capital gain. Similarly, if the house property is purchased after the date of transfer, okay, then also whatever amount has been invested in this new house property will be allowed as exemption as per this formula. I hope this is quite clear. But if the house property is constructed, then such house property should be constructed within a period of 3 years. I hope this is quite clear to you all. Okay, and such amount invested in this construction of the house property will be taken over here, and it will be compared with the gross long term capital gain, and whichever will be lower will be allowed as exemption under section 54. I hope this is quite clear. And then there is a lock-in period. The lock-in period says that whatever new asset has been purchased by the assessee, it will be locked for 3 years. That means the assessee cannot transfer, okay, cannot transfer his new capital asset for a period of 3 years. I hope this is quite clear to you all. Okay, but if the assessee violates this locking period, then exemption claimed earlier should be reduced from the cost of acquisition of new asset. So violation simply means that new asset which was acquired, it has been sold before 3 years. Okay, so full value of the consideration will be received for this new residential house property also. I hope this is quite clear. So on this we will reduce the cost of acquisition also. I hope this is quite clear. So whatever was the actual cost of acquisition will be reduced. For example, 1 crore is the cost of acquisition of this new residential house property. It will be reduced by the exemption that has been claimed under section 54 of rupees 50 lakhs. And that means our cost of acquisition will be only 50 lakhs for this new residential house property, okay, which has violated the lock-in period. I hope this is quite clear to you all. Sounds little complicated, but don't worry, with the help of example number 2, things will become very easy for you all. Okay, so let's move on to our next section, that is section 54B. Section 54B says that if there is an assessee, who is the assessee? The assessee is an individual or HUF, and such assessee is having a capital asset. What is a capital asset? Capital asset is a urban agriculture land used for 2 years, okay, and such urban agriculture land which is a capital asset has been transferred by the assessee, and such urban agriculture land is a long-term capital asset. So how we will identify that this urban agriculture land used for 2 years is a long-term capital asset or not? Firstly, we know that land falls under the range of 24 months, okay. So simply, if this urban agriculture land is been holded by this assessee for more than 24 months, then it will be considered as long-term capital asset. I hope you agree with that. So let's revise up to here. As per section 54B, if there is an assessee and such assessee is an individual or HUF, and such individual or HUF is having an urban agriculture land used for 2 years, and such urban agriculture land is a long-term capital asset, okay, and such long-term capital asset has been transferred by this individual or HUF, and after transfer of such urban agriculture land, the new asset has been acquired by this individual or HUF, and such new asset is any agriculture land that is urban or rural agriculture land in India only, then the amount of exemption available is gross long-term capital gain or amount actually invested in this new capital asset, that is any agriculture land, that is urban agriculture land or rural agriculture land, whichever will be lower of this two will be allowed as exemption under section 54B. I hope this is quite clear. Time limit of making such amount of investment in this new asset is within 2 years from the transfer date. So understand that on 1st April 2019 the agriculture land, which is an urban agriculture land and it is a long term capital asset, is been sold. Okay, so then after the date of transfer, within 2 years, okay, within 2 years the assessee, that is our individual or HUF, should purchase any new agriculture land, that can be urban or rural agriculture land, and whatever the amount has been paid for the acquisition of this new capital asset will be considered over here as amount invested, and it will be compared with the gross long term capital gain, whichever will be lower will be allowed as exemption under section 54B. I hope this is quite clear. And similarly there is lock-in period for this section 54B also. The lock-in period is of 3 years, and if there is a violation, exemption claim earlier should be reduced from the cost of acquisition of a new asset. I hope this is quite clear, so I just don't want to repeat this parts again because it is common for all 3 sections. Okay, so let's revise this section 54B again. Section 54B says that if there is an assessee and such assessee is an individual or HUF, and such individual and HUF is having an urban agriculture land used for 2 years in India, and such urban agriculture land is a capital asset, and such capital asset is a long term capital asset, and such capital asset, which is a long term capital asset, is transferred, and after such transfer a new capital asset has been purchased, that is any agriculture land which is urban agriculture land or rural agriculture land, then an amount of exemption will be available under section 54B. What is the amount of exemption? Gross long term capital gain or amount invested, whichever is lower of this two will be allowed as exemption under section 54B. I hope this is quite clear. Time limit of making the amount of investment in the new capital asset is within 2 years from the date of transfer. I hope this is quite clear to you all. And then there is a lock-in period. The lock-in period is same for section 54B like 54 only. So the lock-in period is 3 years, and if there is a violation, exemption claimed earlier should be reduced from the cost of new asset. I hope this is quite clear to you all. Okay, so let's understand section 54D. Section 54D says that if there is any assessee and such assessee holds a land and building, okay, and such land and building is compulsory acquired, okay, and such land and building was used in an industrial undertaking for 2 years, okay, and if such land and building is a long-term capital asset. Firstly, tell me how we will identify that whether this land and building is a long-term capital asset. So here the capital asset is land and building. So as we have studied earlier also, land and building falls in the range of 24 months. So if this land and building are holded for more than 24 months, then only it will be considered as long-term capital asset. So what is the capital asset over here? Capital asset is land and building which has been compulsory acquired, and such land and building was used in industrial undertaking for 2 years, and such land and building, because it was compulsory acquired, it will be considered as transferred, and after such transfer, okay, a new land and building has been purchased by any assessee, okay, any assessee for industrial undertaking only, then the amount of exemption under section 54D will be gross long term capital gain or amount invested, whichever is lower. So the time limit in order to invest the amount in this new land and building for the industrial undertaking is within 3 years after the compensation received it. Earlier in this two section, that is section 54 and section 54B, what we were studying is the time limit to invest the amount in this new capital asset is from the transfer date, okay, but here the date is different. Here the date is from the date of compensation actually received. For example, understand that on 1st April 2019 the land and building got compulsory acquired, okay, so this is simply known as transfer, okay. On 1st April 2020 the compensation was received, okay, compensation received, okay. So from this date, that is from 1st April 2020 up to 3 years, okay, the assessee can invest their amount in the new land and building for industrial undertaking. I hope this is quite clear to you all, okay. So the lock-in period for section 54D is 3 years only, and if there is a violation of a lock-in period, then the exemption claimed earlier should be reduced from the cost of acquisition of the new capital asset. I hope this is quite clear. Let's revise section 54D. Section 54D says that if there is an assessee and the assessee is any assessee, and such assessee is holding land and building which is compulsory acquired, and such land and building was used in industrial undertaking for 2 years, okay, and such land and building is a long-term capital asset, okay, and such land and building just because it has been compulsory acquired, it will be considered as transferred. After such transferred, the assessee, that means any assessee, has purchased a new land and building for industrial undertaking within a period of 3 years after the compensation has been received, then the amount of exemption under section 54D will be gross long-term capital gain, or the amount invested in the new land and building for the industrial undertaking, whichever is lower, will become our exemption, okay, under section 54D. I hope this is quite clear to you all. And then there is a lock-in period. So the lock-in period says that whatever the new asset has been acquired, okay, it has to be holded for a minimum period of 3 years, okay. If the asset has been sold before the period of 3 years, that is before the lock-in period, then it is considered as violation, and the exemption claimed earlier should be reduced from the cost of acquisition of the new asset in order to calculate the capital gain of the new asset. I hope this is quite clear to you all. So students, we have already studied this section number 54, section number 54B and section number 54D. So how to remember this section? So after reading this section, you can remember automatically what this section is talking about. So always remember that section 54 is about residential house property, okay. Section 54B is about buffalo, okay. Why I am saying it buffalo, I'll explain you. And section 54D can be remembered as a don, okay. So understand this, okay. In section 54B, everything is about residential house property only. See, residential house property, okay. And in section 54B, it is about buffalo. Why I have taken the reference of buffalo? Because this B is there first of all, okay. And because the capital asset owned by this individual is an urban agriculture land. In this agriculture land, who will be used? Buffaloes will be used to plug the land, okay. So that's why buffalo, remember it in this manner. So you can automatically remember the asset is an agriculture land. You just need to remember the urban agriculture land is the capital asset. I hope this is quite clear. Or you can remember this as buffalo is urban, okay. Buffalo is urban, okay. And then the next is 54D. So how can we remember 54D? We can remember 54D as Don. Why I am saying Don? Don is a kind of a person who will come and at the gunpoint he will ask you to give your property. So that is what is happening over here to this any of the assessees, that is they are having a land or building which has been compulsory acquired. So it has been compulsory acquired by the government or any other authority, okay. So they are acting as a Don, okay. So that's why I have written here Don, so that you can automatically recall, oh, 54D stands for Don. In this, land and building are being compulsory acquired, and such land and building were used in industrial undertaking for 2 years. I hope this is quite clear. I hope this will help you, okay. And in order to remember this section, that is 54EC, remember it as Electricity Corporation, okay. So why to remember it as Electricity Corporation? I'll explain you. Don't worry, we need to firstly understand this section. Okay students, so now let's understand section 54EC. Section 54EC says that if there is an assessee, and assessee is any assessee, okay, and such assessee is holding a capital asset which is a land or a building or both, okay, and such includes house property as well as commercial properties also, okay, and such property has been transferred by this assessees, okay, and such asset is a long-term capital asset, okay, then after such transfer, if the assessee purchases or invests the amount in the new capital asset, and such new capital asset is a redeemable bonds of NHAI, NHAI stands for National Highway Authority of India, or invest in a redeemable bonds of RECL. RECL stands for Rural Electrification Corporation Limited, then the amount of exemption under section 54 EC will be gross long-term capital gain amount, or the amount invested in this new asset, or amount of rupees 50 lakhs max, whichever is lower of this three, will be allowed as exemption under section 54 EC. I hope this is quite clear. So let's understand this section once again up to here, okay. So what the section 54 EC says that if there is any assessee, and such assessee is holding a land or a building or both, and such land and building includes a house property as well as includes a commercial property, and how to identify this land and building is a long-term capital asset. This land and building, any which falls in the range of 24 months. So if this land and building are holded by the assessee for more than 24 months, then this capital asset is a long-term capital asset, and such long-term capital asset has been transferred by any of the assessee, okay. Then after such transfer, a new capital asset is acquired, and the new capital asset is a redeemable bond of National Highway Authority of India, or a redeemable bond of Rural Electrification Corporation Limited. Then the amount of exemption under section 54 EC is gross long-term capital gain, or the amount invested or rupees 50 lakh, whichever is lower of this three will be allowed as exemption under section 54 EC. I hope this is quite clear. But the time limit in order to take this exemption under section 54 EC is within 6 months from the date of transfer of what? Of this land or building or both. I hope this is quite clear to you all. Okay students, so now let's understand the lock-in period. There are two lock-in period details, 3 years and 5 years. So simply understand that if this asset, okay, if this asset is sold in the previous year 2019-20, okay, and after the sale of this asset, the redeemable bonds of NHAI or RECL has been purchased within a period of 6 months, then the lock-in period of such new capital asset, that is redeemable bonds of NHAL and RECL, is 5 years from the date of purchase. I hope this is quite clear. But why this 3 years detail is given? Okay, so simply understand that over here in a blank page, if the assessee in the previous year 2017-18 on 1st December 2017 sold a land, okay, and in order to take exemption under section 54 EC, he purchased or invested in bonds of NHAI. Okay, so whatever the amount of capital gain he has earned, it will get exempt, okay, up to rupees 50 lakhs. I hope this is quite clear. So the time limit to purchase this bonds of NHAI is 6 months. So understand that this assessee has purchased this bonds of NHAI on 31st March 2018. Okay, that is within 6 months only. Okay, so from this date up to 3 years, this purchased or invested bonds in NHAI cannot be sold because there was a lock-in period before 1st April 2018. So that's why over here you can see two lock-in period details, that is 3 years and 5 years. Okay, so how to deal with it? If the assessee who has purchased this bonds of NHAI on 31st March 2018, okay, and if he sells this new bonds within a period of 3 years, that means he is violating the lock-in periods provision, okay, given under section 54 EC, and just because he is violating, the exemption of capital gain earlier will be taxable in the previous year in which such bonds are sold. I hope this is quite clear to you all. Okay, so that's why there was this two details. I hope you all have understood this part. So let's revise this section, that is section 54 EC. Section 54 EC says that if any assessee is there and such assessee is having a land or building or both, okay, and such building is a house property including the commercial property also, and this entire thing, that is a capital asset, is a long-term capital asset and has been transferred by the any of the assessee, and after such transfer a new capital asset has been acquired. Which is a new capital asset? The new capital asset is a redeemable bonds of NHAI or RECL. Then the amount of exemption that will be available under section 54 EC is gross long-term capital gain amount or the amount invested in this new capital asset or rupees 50 lakh, whichever will be lower, and the time limit to make the investment in this new capital asset is within 6 months from the date of transfer. I hope this is quite clear to you all. The lock-in period for the new capital asset, that is redeemable bonds of NHAI RECL, is 5 years, okay, when such redeemable bonds of NHAI has been purchased after 1st April 2018, but the lock-in period is 3 years if this new capital asset, which is redeemable bonds of NHAI RECL, has been purchased before 1st April 2018. I hope this is quite clear to you all. Okay, if there is a violation of this lock-in period, then the exemption claimed earlier on the capital gain will be taxable in the previous year in which such bonds are sold. I hope this is quite clear to you all. Okay students, so we have already completed our section number 54, our section number 54B and section number 54D as well as section number 54 EC. How to remember all these sections? Section 54 can be remembered as residential house property. Section 54B can be remembered as Buffalo Urban. Section 54D can be remembered as Dawn. Section 54 EC can be remembered as Electricity Corporation. Okay, so now let's move on to our next table where there are three more sections given. Okay, so let's read it. Section 54EE. Okay, what is this section 54EE is about? Section 54EE says that if there is an assessee, and who is the assessee? Assessee can be any assessee, that is all assessee. Okay, and the asset transferred by this assessee is what? Any long-term capital asset. Okay, that means any of the long-term capital asset. It can be listed equity shares. Okay, it can be long-term property, that is house property, or long-term capital asset, which is a land, okay, any long-term capital asset, okay, and such long-term capital asset has been transferred, and after such transfer a new capital asset has been purchased, which is a new capital asset, units notified by the central government. So basically, if an assessee is there and if that assessee has sold any of his long-term capital asset, and after such sale of the long-term capital asset the assessee is purchasing units notified by the central government, then the amount of exemption available under section 54 EE is gross long-term capital gain or amount invested or rupees 50 lakh, whichever is lower, okay. So the time limit in order to make the amount of investment in this unit notified by the central government is within 6 months from the date of the transfer. I hope this is quite clear. And the lock-in period is 3 years. Lock-in period is for what? Lock-in period is for this units notified by the central government which has been purchased by the assessee, that is acquired by the assessee. I hope this is quite clear. So if the assessee violates the lock-in period, then the exemption claimed earlier will be taxable in the previous year in which such units are sold. I hope this is quite clear to you all. So let's revise section 54EE. Section 54EE is very similar, okay, is very similar to section 54EC. I hope this is quite clear to you all. So how to remember this section 54EE? Remember it as eligible units of central government. I hope this is quite clear to you all. So let's revise this section 54EE. 54EE says that if there is any assessee and such any assessee is holding any long-term capital asset and such assessee is transferring, that means selling any of his long-term capital asset, and after the sale of such long-term capital asset the assessee is purchasing a new capital asset and such new capital asset is the units notified by the central government, then the amount of exemption that can be claimed under section 54EE is gross long-term capital gain or the amount invested in this unit notified by the central government or maximum rupees 50 lakhs, whichever is lower of this three will become our exemption under section 54EE. I hope this is quite clear. But the time limit to invest in this new capital asset after the sale of the old capital asset, that is the long-term capital asset, is within 6 months from the date of transfer. I hope this is quite clear to you all. And the lock-in period of this new capital asset, that is unit notified by the central government, is 3 years. That means this new units that has been purchased by the assessee cannot be sold within a period, okay, within a period of 3 years. I hope this is quite clear to you all. But if the assessee violates the lock-in period, then the exemption of the capital gain earlier will be taxable in the previous year in which such units are sold. I hope this is quite clear to you all. Okay, so now let's understand section 54F. Section 54F says that if there is an assessee and such assessee is an individual or is an HUF, okay, and such individual and HUF is having any capital asset, okay, other than house property, okay, but any other capital asset includes commercial property. I hope this is quite clear. But the capital asset should not be a house property. I hope this is quite clear to you all. And such any other capital asset should be a long-term capital asset. I hope this is quite clear to you all. And after the transfer of this any of this capital asset by this individual or HUF, the new asset acquired by this individual and HUF should be one residential house property. I hope this is quite clear to you all. Okay, so basically the financial crunch is there with the assessee. That's why he is selling all of his capital asset, which is a long-term capital asset. And after the sale of such capital asset, he is using the consideration that has been received for this capital asset for the purchase of this new residential house property. I hope this is quite clear to you all. Okay. Let's revise it up to here again. Section 54F says that if there is an individual or an HUF and they are having any capital asset other than house property and such capital asset is a long-term capital asset, and after the transfer of any such capital asset, the new capital asset acquired is one residential house property, then the amount of exemption under section 54F is cost of new house property, okay, that means this residential house property, into capital gain, that is gross long-term capital gain, okay, divided by net consideration. I hope this is quite clear to you all. What is net consideration? Net consideration simply means full value of consideration minus transfer expenses. I hope this is quite clear to you all. So whatever the amount will come, it will be allowed as an exemption under section what? Under section 54F. I hope this is quite clear. And the time limit to invest in this one residential house property is similar to that we have studied under section 54, that is 1 year before the transfer date or 2 years after the transfer date in case of such new residential house property is being going to purchase, or if such residential house property is going to be constructed, then such residential house property should be constructed within a period of 3 years after the transfer date. Then whatever the amount has been invested in this construction of this new residential house property will be allowed as exemption. Okay, how the exemption will be allowed? The exemption will be allowed in this manner. Cost of this new residential house property, we will write it over here into capital gain divided by net consideration. I hope this is quite clear to you all. And the lock-in period of this new residential house property is 3 years. I hope you know what is lock-in period by now. Okay. So if the assessee makes the violation of this lock-in period, then the exemption earlier claimed by the assessee will be taxable as long-term capital gain in the previous year in which the another residential house property is purchased or the house property is sold. So basically understand this over here. So what does section 54F says that section 54 will apply to an assessee who is having a financial crunch. What does financial crunch means? He is selling all of his capital asset, which is a long-term capital asset, in order to purchase one residential house property. Okay, but there is a lock-in period for this one residential house property of 3 years. That means up to 3 years, this residential house property should not be sold first of all. Okay, and if the asset is not sold but a new asset is purchased, that means another residential house property is purchased within this lock-in period of 3 years, that means it is quite certain that the financial crunch is not there to this assessee. He was just acting to have a financial crunch. That's why the exemption earlier claimed under this section, under section 54F, will be considered as long-term capital gain in the previous year in which another residential house property is purchased or a house property is sold. That means this house property is sold. I hope this is quite clear, and such is done within a period of 3 years. I hope this is quite clear. Even if it is not clear, after revising this section, that is section 54X, things will get little much clearer to you all. Okay, so let's revise this section 54F. Section 54F says that if there is an individual or an HUF who is having any capital asset as a long-term capital asset and they are transferring such long-term capital asset in order to purchase a new residential house property, capital gain that has been earned on this old capital asset, which is a long-term capital asset, will be allowed as exemption under section 54F. So how the exemption under section 54F will be available? So the formula says that cost of new house property, okay, into capital gain divided by net consideration. I hope this is quite clear to you all. And net consideration means full value of consideration minus transfer expenses. Time limit for purchase of this new residential house property is similar to that we have studied in section 54. That is, if the house property is purchased and such house property is purchased 1 year before the transfer date, then whatever the amount has been invested will be considered over here as cost of new house property. But if the asset has been purchased after the date of transfer within 2 years, then whatever the asset has been purchased after the 2 years, that will be considered over here as cost of house property. I hope this is quite clear. But if the house property is constructed, then within 3 years such house property should be constructed, and whatever the cost has been incurred to construct this house property will be taken over here, that is cost of new house property. I hope this is quite clear to you all. And the lock-in period over here is 3 years for this new residential house property. Okay, if the violation is done, okay, and such violation is in this manner, this residential house property is sold or a new residential house property has been purchased by the assessee, okay, which assessee, this individual or HUF, within a period of this 3 years, then the exemption earlier claimed shall be taxable as long-term capital gain in the previous year in which another residential house property is purchased or the house property is sold. I hope this is quite clear to you all. Okay, so now let's move on to our next section, that is section 54G and 54GA. This is a very least important section because this is mostly asked at CA final level, but it is given in your syllabus at CA IPC level also. So in order it has been given in your syllabus, it is my duty to teach you all. Okay, but don't worry about this. Hardly any questions are asked from this particular section. Okay, so let's understand it any which ways. Section 54G and 54GA says that if there is any assessee, okay, and such assessee is having a capital asset which is a land or building, okay, or a plant and machinery of industrial undertaking in an urban area. In which area? In an urban area. Okay, and the period of holding of this capital asset can be either short-term capital asset or can be a long-term capital asset. After the transfer, that means after the sale of this capital asset, the assessee, that means any assessee, is purchasing a new capital asset which is either a land or building, plant and machinery in a rural or a special economic zone area, including notified expenses, okay, then whatever the expenses or whatever the investment has been made by the assessee in this new capital asset, can be allowed as exemption. The formula for exemption under section 54G and 54GA is gross long-term capital gain or the amount invested in the purchase or construction of this new land or building and plant and machinery in rural or special economic zone area, as well as notified expenses will be included with the amount of investment made in purchase and construction of this land and building as well as plant and machinery. Okay, it will be considered over here, and whichever is lower of these two will be allowed as exemption under section 54G and 54GA. I hope this is quite clear. Let's understand the time limit within which the purchase of this new capital asset, that is purchase or construction of land and building or plant and machinery in rural or special economic zone plus notified expenses can be allowed. Okay, so the time limit is within 1 year before the transfer date or within 3 years after the transfer date. I hope this is quite clear to you all. The lock-in period for this new capital asset that has been acquired by any assessee after selling such capital asset and purchasing this capital asset, the lock-in period is 3 years. I hope this is quite clear. If the assessee, that means any assessee, makes the violation of this lock-in period, then the exemption claimed earlier shall be reduced from the cost of acquisition of the new asset. I hope this is quite clear to all. What does new asset means? New asset means this. I hope this is quite clear. Okay, so now let's revise section 54G and 54GA. If there is any assessee and such assessee is having a land and building or a plant and machinery of industrial undertaking in which area, in urban area, and such capital asset can either be a short-term capital asset or can be a long-term capital asset. So after the transfer of this capital asset, a new capital asset has been acquired. Such capital asset either can be purchased or can be constructed. Okay, and such capital asset can be a land and building or can be a plant and machinery in a rural or a special economic area. Plus a notified expenses on this purchase and construction will also be allowed as an exemption under section 54G or 54GA. I hope this is quite clear to you all. The maximum amount of exemption available under this section is gross long-term capital gain or amount invested in this new capital asset. The time limit to make the investment in this new capital asset is within 1 year before the transfer date, okay, of this capital assets, okay, or within 3 years after the transfer date. I hope this is quite clear to you. Lock-in period of this new capital asset is 3 years. I hope this is quite clear. If the assessee violates the lock-in period's provision, then exemption earlier claimed shall be reduced from the cost of acquisition of the new capital asset. I hope this is quite clear to you all. Okay, so our section number 54EE as well as section number 54F as well as section number 54G as well as GA is complete, and our last exemption under section 54GB is there. So let's understand this also. Section 54GB is about company startup. So understand that who is our eligible assessee. The eligible assessee to get an exemption under section 54GB is an individual and HUF. Okay, and the capital asset that is transferred should be a long-term capital asset, and such long-term capital asset should be a residential house property. Okay, in order to claim exemption under section 54GB, there are certain conditions. Let's understand this condition. What does this condition says? Net consideration, that means FVOC less transfer expenses gives us net consideration. Okay, so this net consideration to be utilized before the due date of furnishing ROI, that is return of income, for subscribing equity shares in an eligible company, and the company should within 1 year from the date of subscribing in the equity shares by the assessee should utilize such money for purchase of this new asset. Okay, for the purchase of which new asset we will understand it. Don't worry, let's read it completely. Okay, what does eligible company means and what does eligible startup means? Let's understand it. Such company to be incorporated in the financial year in which capital gain arises. That means the assessee is an individual and HUF, and such assessee is selling this house property. Okay, why he is selling this residential house property? He is selling this residential house property so that he can subscribe to the equity shares of this eligible company. Okay, and this eligible company should be incorporated in the year in which the capital gain has arisen. That means in simple word, understand that this individual is there, he is selling his residential house property in order to start a company. Okay, so then only it can be possible that this assessee is selling his house property and subscribing to the equity share of this eligible company, and such eligible company is incorporated in the financial year in which such capital gain has arisen, and the company is engaged in the eligible business or the startup. What does eligible business or startup means? We will understand it over here. And the assessee has more than 25% of the shareholding or voting rights in this company. That means after selling this house property, residential house property, which is a long-term capital asset for this individual or HUF, this individual and HUF is subscribing to the equity shares of this eligible company which has been incorporated in the financial year in which the capital gain has arisen up to 25% of the shareholding or voting rights in that company. Okay, I hope this is quite clear. Then only the exemption will be available under section 54GB. So be patient, we need to understand other condition also, and then we will see the amount of exemption will be how much. Okay, so just wait, be patient. What does eligible startup means? Because we have studied over here eligible business or eligible startup. So eligible startup simply means that company engaged in eligible business which is incorporated on or after 1st April 2016 but before 1st April 2021. Okay, the total turnover of the business does not exceed rupees 25 crores in any previous year. I hope this is quite clear. So the company should hold a certificate of eligible business. Okay, basically this eligible startup should hold a certificate of eligible business from Interministerial Board of Certificate as notified in the official gazette by central government. Okay, so let's understand what does eligible business means. Eligible business means eligible startup. So basically it is again linking it back to over here. Eligible startup engage in innovation, development or improvement of the products or processes or services or a scalable business model with a high potential of employment generation or wealth creation. Okay, so this is the eligible business. Okay, so if a particular company is involved in this eligible business and is holding a certificate of this eligible business from Interministerial Board of Certificate as notified in the official gazette by the central government, then it will be considered as eligible startup. Okay, I hope this is quite clear. Then finally the amount of exemption. Okay, why the amount of exemption we are considering? Because if the individual is selling his residential house property, he will definitely earn a capital gain on such residential house property. Okay, so in order to not to pay the tax, he may invest as per the direction given under section 54GB and claim an exemption under section 54GB. I hope this is quite clear. The amount of exemption will be equal to gross long-term capital gain amount, that is CG amount stands for capital gain amount, into cost of new asset divided by net consideration. What does net consideration means? FVOC minus transfer expenses gives us net consideration. I hope this is quite clear. So let's understand the lock-in period. The lock-in period is 3 years for computers or software in case it is an eligible startup, or 5 years in case of any other asset. I hope you all have not understood a single word also, but in order to understand this, we need to read this first of all completely. Okay, so now let's understand it with part by part. Okay, so section 54GB specifically says that this individual intends to start a company. Okay, and in order to start a company, he is not having fund. Okay, so in order to receive funds, he has sold his residential house property which is a capital asset. Okay, and whatever consideration he has received, he is using this net consideration, okay, for subscribing equity shares in this eligible company, and such subscription in the equity shares in this eligible company is done before the due date of furnishing ROI. What is this? We will understand it when we will study assessment chapter. Okay, so don't worry about that. Okay, and the company should, that means once the assessee, that means individual, has subscribed to this eligible company, then the company itself should within 1 year from the date of subscription of such equity share by this individual, that is our assessee, should utilize such subscription amount that has been received on the equity shares in this company for purchasing of this new capital asset. Okay, and the lock-in period is for this new capital asset, that is what we have studied over here. The lock-in period is 3 years for computer is an asset, software is also an asset, so it is 3 years in case of computer or software when such company is an eligible startup, or 5 years in any other asset. I hope this is quite clear to you all. Okay, so the eligible company, what does eligible company mean? Such company should be incorporated in the year in which the capital gain arises. So basically when the assessee sells his residential house property, then only he thinks of incorporating this new startup company. So that means in that same year only, that is the financial year, the assessee will incorporate the company, and company should be engaged in the eligible business or startup. Okay, and such assessee should hold more than 25% of the shares in this eligible company. I hope this is quite clear to you all. Okay, so simply understand that eligible company means the company incorporated in the year when the asset, that means this residential house property, is transferred, and the assessee is holding 25% in this company. I hope this is quite clear. That means 25% shareholding in that company. What does eligible startup means? Company engaged in eligible business. That means eligible business means engage in innovative activity, development activity, or improvement of the product activity, or processes or services, or a scalable business model with a high potential of employment generation or wealth creation, then it will be considered as eligible business. So what does eligible startup means? Company engaged in this eligible business which is incorporated on or after 1st April 2016 but before 1st April 2021. The total turnover of the business does not exceed 25 crore in any previous year, and such eligible startup, that means this eligible company, holds a certificate of the eligible business from Interministerial Board of Certificate as notified in the official gazette by the central government. I hope this is quite clear to you. Then the amount of exemption will be allowed is gross long-term capital gain, that is capital gains amount, into the cost of new asset that has been purchased by the company, okay, not the amount that has been invested by the assessee. I hope this is quite clear. The assessee has invested the amount, that is a different thing, but the invested amount as equity shares, but the invested amount that the company has received by issuing the equity share to this individual, the company should use such subscription amount of the equity shares for the purchase of new capital asset. So cost of new capital asset we have to mention over here, and then we have to divide it with the net consideration. Then whatever amount we will get over here, that will be allowed as exemption under section 54 GB. I hope this is quite clear to you. This is one of the complicated exemption given under section 54 GB. Don't worry, in exam, if the examiner wants to ask a question on this, he has to frame a question, and if he frames a question, he have to give you all this detail, okay. So there is a very rare possibility that they will ask the question on this, but you need to be prepared for this, okay. Solve 2-3 sums on this from the study material and it will be very easy for you, okay. And the lock-in period is for the assets, okay, that the assets has been purchased by this new company. The lock-in period is for that. So lock-in period is 3 years for computer software in case of eligible startup, or 5 years in case of any other asset. I hope this is quite clear to you all. So here our exemption under section 54 to 54 GB comes to an end, and now we can solve example number 2 in our notes only, okay. So let's come into example number 2 and we will solve this example number 2. Okay students, so now we will solve our example number 2. Okay, what does example number 2 says? Example number 2 says that Mr. Radhe has a house property which is a capital asset, okay, and Mr. Radhe has purchased such house property in the financial year 2005 and 6 for rupees 12 lakhs, okay, and Mr. Radhe did renovation to such house property in the financial year 2010-11 at the rate rupees 10 lakh. So basically this is cost of improvement. What is cost of improvement? We will understand it, don't worry about that. Then the detail given in the question is Mr. Radhe sold this house property for rupees 65 lakh in the previous year 1920. Stamp duty value of such house property in case 1 is 70 lakh, in case 2 it is 67 lakh, and in case 3 it is 60 lakhs, okay. And value as per valuation officer, VO stands for valuation officer, is 72 lakhs in case 1, 66 lakhs in case 2, and 64 lakhs in case 3. I hope this is quite clear to you. And what the question is asking us to find out, the question is asking us to calculate capital gain on such transfer of capital asset. The question is not asking us to find out the tax on such capital gain. I hope this is quite clear. And the next part of this example number 2 is Mr. Radhe wants professional advice from you as a tax advisor that how to save a tax on such capital gain. I hope this is quite clear. So for this part, section 54 to section 54 GB will get triggered. I hope this is quite clear. So let's move into our format book and start solving this sum, okay. So the name of the assessee is same only because it is the extension of question number 1 only, and residential status is also same. Period of holding will also remain same. Capital asset is house property only, and such capital asset is a long-term capital asset. I hope this is quite clear to you all. So the primary thing required to compute a long-term capital gain if the capital asset is a long-term capital asset is full value of consideration. So how to calculate full value of consideration? Full value of consideration has to be calculated as per section 50C. I hope this is quite clear to you all. So let's come back to the notes, okay. Because of this part, okay, because of this value as per valuation officer, the method of calculating FVOC, that is full value of consideration, will change. How it will change, let's understand it over here in section 50C, okay. This first part we have already studied, okay. So let's study the next part. The next part says that if a dispute arises relating to stamp duty value, okay, then a reference is made to a valuation officer. Okay, this valuation officer is just an income tax officer. I hope this is quite clear to you all. So simply understand that whenever in the question, if value as per valuation officer is given to you all, just simply understand that there might have arise some dispute relating to stamp duty value. That's why a reference is made to a valuation officer. And if a reference is made to a valuation officer, then this first method will not be applicable. I hope this is quite clear. So that's why there is three different methods to calculate full value of consideration. I hope this is quite clear. First says that if amount as per valuation officer, okay, if amount as per valuation officer means amount derived by the valuation officer for such house property is more than stamp duty value, then full value of consideration is equal to stamp duty value. I hope this is quite clear to you all. And in the point number 2, it says that if amount as per valuation officer as derived by this valuation officer for house property is less than stamp duty value, and the amount as per the valuation officer as derived for this house property is more than the actual consideration received, then the full value of consideration is equal to amount as per the valuation officer. I hope this is quite clear to you all. Okay, but if the amount as per the valuation officer derived by this valuation officer for this house property is less than consideration received, then the full value of consideration is equal to consideration actually received. I hope this is quite clear. So let's come into our example. Okay, so now we have to calculate full value of consideration. Okay, in this case 1, the stamp duty value as per the stamp duty valuation authority is 70 lakhs and the value as per valuation officer is 72 lakhs and actual consideration is 65 lakhs. So we need to calculate the full value of consideration. Okay, so you can see that valuation as per the valuation officer is 72 lakhs and stamp duty value as per the valuation authority, that is stamp duty valuation authority, is 70 lakhs. So 72 lakhs, okay, that is VO's value is higher than the stamp duty value. I hope this is quite clear to you all. So if this is the case, then what the section 50 says, the section 50 says if the amount as per valuation officer is more than stamp duty value, then full value of the consideration is equal to stamp duty value. So in this case 1, okay, in this case 1, the value, that is full value of consideration, will be equal to stamp duty value. So let's calculate it over here. Okay, let me put a line over here. Okay, so understand that valuation officer's value is 72 lakhs, okay, and stamp duty valuation authority's value is 70 lakhs. Since you can see that valuation officer's value is higher than stamp duty value, therefore full value of consideration is equal to stamp duty value, which is equal to 70 lakhs. I hope this is quite clear. So let's come into our format book and let's feed this detail of 70 lakhs. I hope this is quite clear to you all. Okay, we will feed 70 lakhs in both the columns. Okay, column 1 is with indexation and column 2 is without indexation. I hope this is quite clear to you all. Okay, so transfer expenses is given or not, we have to see in the question. Okay, so in this question transfer expenses has not been specified, so we will come into format book and we will erase this because this was a part of example number 1. Okay, so since no transfer expenses is given, we will put a dash. Okay, and we will calculate net consideration. Net consideration will be equal to 70 lakhs. Okay, in this column number 2 also it will be same only. Okay, index cost of acquisition. So the question says that the house property, okay, was purchased for rupees 12 lakhs, okay, in the financial year 2005 and 6, okay, and the house property is sold for the previous year 2019-20. Since the house property is a capital asset and this capital asset is a long-term capital asset, indexation option is available to Mr. Radhe. So we can calculate indexation. We have already calculated earlier, which was 12 lakhs into 289 divided by 117. It was equal to 29 lakhs 64,103. I hope I am correct at this point. Let's calculate it. 12 lakhs into 289 divided by 117. Okay, so it is equal to 29 lakhs 64,103. I hope this is quite clear. And in place of this column where we are calculating without indexation, okay, we will consider cost of acquisition only, which will be equal to 12 lakhs. I hope this is quite clear. So is there any detail given about this index cost of improvement? The answer is yes. In the question, the detail has been given about the cost of improvement. So let's read that. Mr. Radhe did a renovation to such house property in a financial year 2010-11 at the rate rupees 10 lakh. What does renovation means? Renovation means decorating the house or enhancing the capacity of the house. I hope this is quite clear. So here cost of improvement is given. Cost of improvement simply means renovation. Okay, if such cost of improvement is done on the house property, okay, before 2001, then whatever the cost has been incurred on this improvement or this renovation, we have to ignore it. We cannot consider it over here. Okay, we cannot consider it over here because it has been incurred before 2001. I hope this is quite clear. But if the cost of improvement, that is renovations, have been incurred after 2001, okay, and such cost of improvement has been incurred by the assessee, then whatever the expense has been incurred will be allowed, depending upon indexation is allowed or not. Okay, I hope this is quite clear to you all. And if the cost of improvement is done, that means renovation is done after 2001, and this renovation is done by the previous owner, then also it will be allowed. What does this previous owner means? You will understand this particular part, okay, after example number 4. Okay, so be little patient. Till now we need only this much part. Okay, so let's come into the example number 2. Example number 2 says that Mr. Radhe did renovation to such house property in the financial year 2010-11. That means such renovation is done after 1st April 2001. I hope this is quite clear. And the period of such renovation is a long term period or a short term period that we have to ascertain. Since the house property is a long-term capital asset, then this cost of improvement that has been incurred by the assessee will be allowed for indexation. Okay, but it is at the discretion of the assessee to take a indexation or not to take a indexation. In this column specifically where indexation is not followed, we can simply put the amount as 10 lakh over here as cost of improvement. But over here in this column where indexation method is followed, we have to calculate index cost of improvement. So how to calculate this index cost of improvement, we will see over here. So index cost of improvement will be calculated in this manner: actual cost of improvement, which is equal to 10 lakhs, into index cost of inflation for date of transfer, that is in the previous year the asset has been transferred, the previous year 2019-20. So the index cost of inflation is 289. I hope this is quite clear for the previous year 2019-20. Okay, but the index cost of inflation of the year of improvement, that is 2010 and 11. Okay, in this year 2010 and 11 the actual improvement took place. Okay, so we need to find out index cost of inflation figure. Okay, so let's come into our study material. So actual improvement took place in the financial year, okay, in the financial year 2010-11, and the index cost of inflation figure is 167. I hope this is quite clear. So let's come into our format book. We will calculate it over here. 10 lakhs into 289 divided by 167. How much is the index cost of improvement? Let's see that. 10 lakhs into 289 divided by 167. So index cost of improvement is equal to 17 lakhs 30,539. I hope this is quite clear. So we will feed this figure over here. 17 lakhs 30,000 539. I hope this is quite clear. And then we will find out our gross long-term capital gain. So let's calculate gross long-term capital gain where indexation method is followed. Okay, 70 lakhs minus 29 lakhs 64,103 minus 17 lakhs 30,539, which is equal to 23 lakhs 5,358. I hope this is quite clear. And in case where indexation is not followed, the gross long-term capital gain is equal to 70 lakhs minus 12 lakhs minus 10 lakhs, which is equal to 48 lakhs. I hope this is quite clear to you all. Okay, so this is our gross long-term capital gains amount. Okay, so that is what our question was asking. Calculate the capital gain on such transfer of capital asset. So this point is complete. Okay, so we have calculated gross long-term capital gain amount. Okay, then the next thing what the question is asking us to do, is Mr. Radhe wants a professional advice from you so as he can save the tax on such capital gain as per section 54 to section 54 GB. So we have already studied section 54 to section 54 GB. Okay, there we have studied if an assessee is having a residential house property as per section 54. Okay, so assuming that in this question Mr. Radhe was having a residential house property, okay, then If such assessee, that means Mr. Radhe, purchase an another residential house property, then the gross long term capital gain or amount invested in such new residential house property, whichever will be lower, will be allowed as exemption under section 54. So we can advise Mr. Radhe that he can purchase a house property above this figure. Okay, I hope this is quite clear to you all. Similarly, over here also we can advise Mr. Radhe that please do not follow this without indexation method. Okay, because if you are planning to purchase an another house property, then following this is not a appropriate thing, because here you can see that the gross long-term capital gain is 48 lakhs, but when indexation method is followed, then the gross long-term capital gain is 23 lakh 5,358. I hope this is quite clear to you all. And if Mr. Radhe follow this method, that is indexation method, then he can purchase a property of minimum 23 lakhs 5,358, and the entire amount can be allowed as exemption. But if he follows this method, okay, then he has to purchase the house property of minimum 48 lakhs. So why to spend more when you can already spend less and can take this exemption entirely? I hope this is quite clear. So under section 54, Mr. Radhe can take the exemption. Okay, so that is what we have studied in our notes. Okay, in this section 54 to 54 GB, that if the assessee is an individual and having a residential house property, and such residential house property is a long-term capital asset, and such residential house property has been transferred, then such new capital asset can be acquired after the sale of this old residential house property, and whatever the amount has been invested, it will be compared with gross long-term capital gain, whichever will be lower will be allowed as exemption under section 54. I hope this is quite clear. So that is what we are advising him. Okay, so if he even spends only this much amount, it will be allowed as entire exemption under section 54. I hope this is quite clear. But if Mr. Radhe purchases a house property of 25 lakhs, okay, then the amount invested is 25 lakhs, okay, and the gross long term capital gain is 23 lakhs 5,358. Whichever is lower of this two, that is 23 lakh 5,358, will be allowed as exemption under section 54, irrespective Mr. Radhe has invested in a new residential house property of rupees 25 lakhs. I hope that is quite clear. That is what we have studied over here, okay, in section 54. I hope this is quite clear. So is there any other option available to Mr. Radhe other than section 54? Yes, there is other options available. So the next option is available under section 54 EC, which says that if there is any assessee, and such any assessee is having a land or building or both, or in fact having a house property including commercial property, and such property is a long-term capital asset, okay, then whatever capital gain the assessee has earned, it can be utilized for the purchase of a new capital asset, which is redeemable bonds of NHAI or RECL. Okay, then the amount of exemption available under section 54 EC is gross long term capital gain, amount invested, or rupees 50 lakh, whichever is lower. Okay, so we can simply advise this Mr. Radhe that you can invest this entire 23 lakh 5,358 in the bonds of NHAI or RECL. Okay, so investing this much amount, okay, that means gross long term capital gain amount, and this only is the amount that has been invested. Okay, these both amounts are this only 23 lakh 5,358, okay, and 50 lakhs, whichever is lower of this three, that is 23 lakh 5,358, it will be allowed as exemption under section 54 EC. I hope this is quite clear to you all. Okay, but the catch over here is we have to advise Mr. Radhe that you have to purchase the redeemable bonds of NHAI or RECL within a period of 6 months from the date of transfer of such house property. I hope this is quite clear. Mr. Radhe is asking us again, is there any other exemption other than 54 and 54 EC? So we can say yes, there is one more exemption under section 54 EE. So as per section 54 EE, if there is any assessee and such assessee is having any long-term capital asset, and such long-term capital asset has been transferred by such assessee, and the assessee is purchasing the units notified by the central government, then the amount of exemption available is gross long-term capital gain, amount invested, or rupees 50 lakh, whichever is lower. So this is basically similar to section 54 EC, okay. But here the assessee has to invest the money in the units notified by central government. I hope this is quite clear to you all. So whatever amount the assessee invest, it will be allowed as exemption. He can either invest the entire amount, or he can invest either a lower amount, or he can invest up to a 50 lakhs amount, but the maximum deduction available is of 23 lakh 5358. So for example, understand that Mr. Radhe told us that he can only invest 15 lakhs in this units notified by central government. Okay, so that means the amount invested is of 15 lakhs. Okay, gross long term capital gain is of 23 lakhs 5358, and maximum limit is of 50 lakhs. So whichever is lower of this three will be allowed as exemption under section 54 EE. I hope this is quite clear. So whichever is lower of this three was 15 lakhs. So 15 lakh we will consider it over here. I hope this is quite clear to you all. Mr. Radhe asked us that whether he has to invest only under a particular section, or he can invest under two different sections. That means he wants to partly invest in under section 54, under section 54 EE, and under section 54 EC. Can he do so? The answer is yes, he can do partly. As much as he wants, he can invest as per his own will. That means if he uses exemption under section 54 EC, he can invest 10 lakhs amount in bonds of NHAI, okay, and the remaining balance amount of 13 lakh 5358 he can invest under the units notified under central government. Still he will get the exemption of the entire amount. Here we have to write exemption under section 54 EC as well as exemption under section 54 EE. I hope this is quite clear. So Mr. Radhe is again asking, is there any other option to save this capital gain? The answer is yes. Let's come into the notes again. Okay, section 54F will not be applicable because here the assessee is not having a house property, he is having a financial crunch. That's why he is selling all of his capital asset and purchasing one residential house property. So let's see which other option is available to this assessee, that is Mr. Radhe. So the next option available is option under section 54GB. This is quite a complicated option, but still this option is available because the eligible assessee is individual and HUF, and the capital asset transferred is long-term capital asset, and such long-term capital asset is a residential house property. I hope this is quite clear. So let's come back to our example. Okay, so I hope you all understood this part. Okay, so if you have understood, we will not repeat this part again and again. We will only solve this parts. Okay, that is case number 2 and case number 3. I hope this is quite clear to you all. Okay, so let's come into the format book. Here the exemption we have to claim. That means the entire exemption can be claimed by the assessee. Okay, so the long term capital gain will be 0, and finally no tax will be calculated. I hope this is quite clear, and this particular method will not be followed, okay, if the assessee is going to invest the money, okay, as per section 54 to 54GB. I hope this is quite clear to you all. So let me pause the video and I'll erase all this stuff, and then we will solve case 2 and case 3. Okay, so I have erased all of this, okay, whatever we have solved in case 1. Now let's solve case 2. Okay, this case 2 of this example number 2. Okay, what does this case 2 say? Stamp duty value of such house property is 67 lakhs and value as per valuation officer is 66 lakhs. Okay, so we will again compare it over here. The value as per valuation officer is 66 lakhs, okay, and the value as per stamp duty valuation authority is 67 lakhs. So we have to evaluate whether stamp duty value is higher or the value given by the valuation officer is higher. So as we can see that stamp duty value is higher. Okay, so there is point number 2 in our notes over here, okay, where it is said that if the amount as per valuation officer is less than stamp duty value. So in this case 2, that is what we can see is value as per valuation officer is lower than the stamp duty valuation authority. So how to calculate the full value of consideration? The full value of the consideration will be calculated in this manner. If the amount as per the valuation officer is less than stamp duty value, but the amount as per the valuation officer is more than the consideration received, then the full value of consideration is equal to amount as per valuation officer. So let's come back over here. So as we can see that the second point is applicable in this case number 2, which says that valuation officer's value is 66 lakh and stamp duty value is 67 lakh. Since it is less, we have to again compare the valuation officer's value, okay, with the actual consideration, okay, the actual consideration. So actual consideration is 65 lakhs, and after comparing we can see that the value as per valuation officer is higher than the actual consideration. So therefore the full value of the consideration will be equal to value as per valuation officer, which is equal to 66 lakh. So in our format book we will write over here full value of consideration 66 lakhs. I hope this is quite clear to you all. Okay, and the remaining part will be same as we have solved earlier also, so I'll not waste any much time over here. I'll just simply feed the details and you just understand it. Okay, because explaining it to you again and again you will also feel irritated. Okay, so I have already calculated this for you all. Okay, so exemption under section 54 to 54 GB is available. So we have already advised Radhe the tax planning that he can do. So we don't need to mention it over here again. Okay, so now let's solve the last part, that is case 3. Okay, of this example number 2. The case 3 says that stamp duty value of such house property is 60 lakhs and the value as per valuation officer is 64 lakhs. So let's feed the detail over here and let's see again. Valuation officer's value will be compared firstly with the stamp duty value. So the valuation officer's value is 64 lakh and the value as per the stamp duty valuation authority is 60 lakhs. So whichever is higher or lower, we have to ascertain it. So as we can see that value as per valuation officer is higher. So in this note what we have studied that in this point number 3, if the amount as per valuation officer is lower than the consideration received, then the full value of consideration is actual whatever is received. I hope this is quite clear to you all. So since you can see that in this particular case we don't need to compare it with the stamp duty value. Okay, so we need to compare this valuation officer's value firstly with this actual consideration, that is of 65 lakh. So we will write it over here consideration. Okay, and we will feed the detail, okay, which is 65 lakh. So since you can see that consideration is higher than the value as per valuation authority, so full value of the consideration will be equal to the consideration that has been actually received, that is 65 lakhs. I hope this is quite clear. And over here in place of full value of consideration we will simply put 65 lakhs and calculate our gross long term capital gain. I hope this is quite clear to you all. So basically over here figures will change, 65 lakh, 65 lakh, and finally over here also 18 lakh 5,000 and over here 43 lakhs. I hope this is quite clear to you all. Okay, so this is how the sums has to be solved in exam. I hope this is quite clear to you all. So I hope you all have understood this part. Okay, so let's revise section 50C, which talks about full value of consideration. Full value of consideration in case of land and building or both, if stamp duty value is more than 105% of the consideration actually received, then full value of consideration is equal to stamp duty value. Otherwise, that means stamp duty value, if it is less than 105% of the consideration actually received, then full value of consideration is the actual consideration received, not 105% of the consideration. I hope this is quite clear to you all. Okay, but if there is a dispute relating to stamp duty value and then a reference is made to a valuation officer, then we don't need to see this first part. Okay, we need to see this part. What this part says is, first, if amount as per valuation officer is higher than stamp duty value and it is also higher than this consideration received, then full value of consideration is stamp duty value. I hope this is quite clear. If amount as per valuation officer is less than stamp duty value but the amount as per the valuation officer is more than the consideration actually received, then the full value of the consideration will be equal to amount as per the valuation officer. I hope this is quite clear. But if the amount as per the valuation officer is less than the consideration received, irrespective whatever is the stamp duty value, okay, then full value of the consideration will be equal to actual consideration received. I hope this is quite clear. So our section 50C is completely done. Okay. So let's revise transfer expenses. Transfer expense is the expense incurred in connection with transfer of asset. Which asset? Capital asset. So let's understand the example of transfer expenses. First is registration fees, brokerage, stamp duty paid by the owner of such capital asset. I hope this is quite clear. Second point says that amount paid to the tenant to vacate the property due to the clause in the agreement is also a valid example for transfer expenses. I hope this is quite clear. And this third point we will understand it after understanding capital asset, okay, which is listed equity shares. I hope this is quite clear to you all. Okay. So what is this section 48? We will understand when we will be studying listed equity shares, okay, which is a capital asset. Okay, so understanding it right now will be something illogical. Then what does cost of improvement means? Cost of improvement means renovation. Okay, if the cost of improvement is done before 2001, that is 1st April 2001. Okay, so wait, I specify it over here, before 1st April 2001. So understand that if the cost of improvement is actually done before 1st April 2001, then whatever the cost of improvement cost has been bared by the owner, it won't be allowed to be reduced from the net consideration. I hope this is quite clear to you all. Okay. And similarly, if the cost of improvement means renovation which has been incurred by the owner, okay, after 1st April 2001, then if such expenses of cost of improvement has been incurred by the assessee himself, then whatever expense has been incurred will be allowed as a reduction, that is can be reduced from the net consideration. I hope this is quite clear to you all. Less cost of acquisition or index cost of acquisition. Okay, but if such cost of improvement has been incurred by the previous owner, then also it will be allowed as reduction, that is can be reduced from the net consideration. I hope this is quite clear. So what is that? Basically we will understand it when we will study example number 4. I hope this is quite clear to you all. Okay, so till here we have completed everything and example number 2 is also complete, and we have completed this section 54 to 54 GB also. Up till now we have completed more than 50% of income from capital gains chapter. Now only few miscellaneous things are pending, and one major part, that is capital asset being listed equity shares, are pending. Okay students, so now let's solve example number 3. Example number 3 says that Mr. Radhe has a gold bar. Okay, gold bar means gold biscuit. It is technically known as bullion. Okay, and this bullion is a capital asset. Okay, Mr. Radhe has purchased this gold bar, that is a capital asset, in the financial year 2005-6 for rupees 10 lakhs. Okay, Mr. Radhe sold this capital asset for rupees 60 lakhs in the previous year 2019-20, and the question is asking us to calculate the capital gain on such transfer of the capital asset. They are asking us to only calculate the capital gain figure, not the tax on this capital gain. I hope this is quite clear to you all. And further they are asking us that Mr. Radhe wants a professional advice from you as a tax advisor, that how to save tax on such capital gain. So basically they are asking us to give an advice as per section 54 to section 54 GB. I hope this is quite clear to you all. Okay, so let's move into our format book and let's fill the basic details. Name of the assessee is Radhe. Okay, and residential status not given, so we will assume resident, ordinary resident. Okay, capital asset is bullion. Okay, and period of holding we need to ascertain. So basically this gold bar, that is bullion, falls under the range of 36 months. Okay, that is any other capital asset. You can see that this gold bar, that is the bullion, has been holded by Mr. Radhe from financial year 2005-6 to financial year 2019-20. So this is more than 36 months any which ways. So we will mention it over here, more than 36 months. I hope this is quite clear. And we will write over here, this bullion is a long-term capital asset. So which format we will use? We will use this format, that is computation of long-term capital gain format, other than listed equity shares. I hope this is quite clear. Full value of the consideration will be 60 lakhs. I hope this is quite clear. Section 50C was only for land or building or both. Okay, so I told you earlier also, if any other capital asset other than this land, building or listed equity shares, then the full value of consideration will be the actual value of the consideration received. In this case it is 60 lakhs, so we will mention it over here. Okay, 60 lakhs. I hope, wait, I'll change the color. 60 lakhs, okay, and transfer expenses is not given in the question, so we will put a dash over here. Net consideration will be finally equal to 60 lakhs only, okay, and the question gives us the detail that the asset, that is the gold bar, okay, has been purchased in the financial year 2005 and 6 for rupees 10 lakhs. So we can calculate the index cost of acquisition, okay. Since the asset is a long-term capital asset, it is at the discretion of the assessee, that is Mr. Radhe, to either follow indexation, okay, or not to follow indexation. I hope this is quite clear. But since the question is asking us this last part, that is Mr. Radhe wants a professional advice from you as a tax advisor that how to save tax on such capital gain, then we will not follow this method, because any which ways here the long term capital gain will be lower, and such long term capital gain can be used to make an investment and then finally get an exemption under section 54 to 54 GB. I hope this is quite clear. So we will not fill any details over here in this column, okay. So index cost of acquisition, we will calculate it, okay. So we will calculate it over here only. So the actual cost of the acquisition of this gold bar was 10 lakhs, okay. I hope this is quite clear. And the index cost of inflation for the date of transfer is 289, because the gold bar, this gold bar has been transferred in the previous year 2019-20, and as per our study material, in the financial year 1920 the cost inflation index is 289. So that is what only I have taken over here, okay. And this gold bar has been purchased in the financial year, that is 2005 and 6. So we need to find out index cost of inflation for that year, that is for the financial year 2005 and 6. The index cost of inflation is 117. I hope this is quite clear to you all. So we will mention over here 117 and we will find out index cost of acquisition for this gold bar, okay. 10 lakhs into 289 divided by 117. Wait, by mistake I did something wrong, okay. So the index cost of acquisition is equal to 24 lakhs 70,000 and 85 rupees. I hope this is quite clear to you all. So we will mention it over here, 24 lakhs 70,000 and 85, okay. And there is no index cost of improvement, because in gold there cannot be any index cost of improvement, so that's why we'll put a dash over here. And our gross long term capital gain will be equal to minus plus 60 lakhs, which is equal to 35 lakhs 29,915. I hope this is quite clear to you. So basically this is a gross long term capital gain figure as asked by the question, okay. And then the next thing what the question asked us, Mr. Radhe wants a professional advice to save the tax on such capital gain. So Mr. Radhe has earned a capital gain of 35 lakhs 29,950. How can he save the tax? He can save the tax as per section 54 to section 54 GB. So let's come into the notes, okay. So section 54 will not be applicable because the asset transfer should be residential house property. Section 54B will also not be applicable. Section 54D will also not be applicable. Section 54EC will also not be applicable. Then which sections will be applicable? Section 54EE as well as section 54F will be applicable. I hope this is quite clear to you all, okay. So what the section 54EE says, that if any assessee, that means it includes individual, that is Radhe is also included in this, okay, and any capital asset, that is a long-term capital asset. Gold bar is also a capital asset and it is already a long-term capital asset, and such asset has been transferred. And in order to claim exemption under section 54EE and to save tax on capital gain, Mr. Radhe can purchase the units of notified central government, okay, and whatever is the gross long-term amount or the amount invested in this unit notified by the central government, or rupees 50 lakh, whichever is lower, will be allowed as exemption under section 54EE. So for example, if we assume that gross long-term capital gain is only the amount that has been completely invested by the assessee in this unit notified by the central government, then the entire amount of this 35 lakh 29,915 will be allowed as exemption under section 54EE. I hope this is quite clear to you all, okay. So let's move to section 54F, okay. Section 54F says that the exemption under section 54F will be available to an individual or HUF if such individual or HUF transferred any capital asset other than the house property. Since over here the asset transferred is gold, okay, and it is not a house property, okay, and such gold is a long-term capital asset, okay. And in order to claim an exemption under section 54F, the assessee, that means our individual, that is Radhe, has to purchase one residential house property provided the assessee is not having any house property. Okay, that is what this last violation part was telling us. The assessee should not be having any residential house property. That's why he is purchasing one residential house property by selling all of his capital asset. I hope this is quite clear. So there is a formula in order to calculate the amount of exemption. So for that we will need firstly the cost of new house property, okay, as well as we'll need a capital gain amount, and then we will need a net consideration amount. Okay, so for example, for the simplicity 6, assume new house property purchased at the rate 50 lakhs. Okay, so how much will be the amount of exemption? So the amount of exemption under section 54F is equal to cost of new house property, which is 50 lakhs, okay, into capital gain amount is 35 lakh 29,915. Okay, so we will mention it over here, and then it will be divided by the net consideration. Net consideration is 60 lakhs, so we will divide it by that 60 lakhs only, and whatever the amount will come, it will be equal to the exemption under section 54F. So let's calculate that. 50 lakhs, okay, divided by 60 lakhs into 35 lakh 29,915, which is equal to 29 lakh 41,595. I hope this is quite clear to you all. So we will take this figure over here, 29 lakhs 41,559. Okay, so any balance amount will become our final long-term capital gain. So let's calculate any balance amount minus plus 35 lakh 29,915, which is equal to 5 lakh 88,390. So on this, tax will be calculated at the rate 20%. Okay, so which is equal to 20%, 1,17,663. I hope this is quite clear. So basically this part was not asked in the question, but I solved it so that I can explain you this thing. I hope this is quite clear. So basically, if Mr. Radhe wants to save tax, he has two options, that is section 54EE or section 54F. Okay, if Mr. Radhe feels that if section 54EE's investment is of no use for him, he can make an investment as per section 54F, that is of one residential house property, provided the assessee, that means Mr. Radhe, is having no house property. I hope this is quite clear to you all. So I hope you all have understood this part also. Okay, so our example number 3 also comes to an end. That is what I wanted to explain you, so that this entire table, so that this entire section 54 to 54 GB, I can explain it to you. I hope this is quite clear to you all. Okay, so let's come back to our examples now. Okay, so we have completed example number 3. Okay, and we need to complete example number 4 now. Okay, so now let's start with our example number 4. What does example number 4 says that? Example number 4 says that Mr. Radhe received a gift of house property from his father in the financial year 2011 and 12. Okay, so basically if you remember income from other sources, there we have studied if an assessee, okay, in our case this assessee is Mr. Radhe, and such assessee has received a gift from Ram D. Hartley G. Okay, then whatever the gift has been received by this assessee from this people will be allowed as exemption. I hope this is quite clear to you all. Okay, so in simple words we can see that section 56 subsection 2 subsection 10 will not get triggered if that assessee receives a gift from Ram D. Hartley G. So basically this father falls in the category of Ram D. Hartley G, specifically relative. I hope this is quite clear. So let's read it from start. Mr. Radhe received a gift of house property from his father in the financial year 2011 and 12. Father has purchased such house property in the financial year 2002 and 3 at the rate rupees 12 lakh. Okay, Mr. Radhe sold this house property in the financial year 1920, that is our previous year 1920, at the rate rupees 60 lakh. Stamp duty value of such house property is 65 lakhs. Okay, FMV of house property when Radhe received it is rupees 20 lakhs. FMV, that is fair market value of the house property when Radhe received this house property, that is in the financial year 2011 and 12, it was rupees 20 lakhs. Okay, transfer expenses, that is brokerage, at the rate 5%. So let's solve this part. Okay, here we will understand a new concept, that is section 49. Okay, so we'll understand that. Okay, so let's come into our format book. Let's erase these details and we will mention the details again. Okay, so the name of the assessee is again Mr. Radhe. Mr. Radhe. Residential status is not given, so we will assume resident, ordinary resident. And the capital asset that has been sold by Mr. Radhe is the house property that he has received as gift from his father. Okay, so we will mention it over here, house property. I hope this is quite clear to all. And we need to mention the period of holding. Since the important thing is period of holding, that's where section 49 comes into picture. Okay, so let's come into the notes. Okay, and I'll explain you section 49. So come on section 49 in order to determine period of holding and the actual cost. Okay, so come to point number 2 in this particular table. If the asset is transferred under will, or if the asset is transferred as a gift, if an asset is transferred as inheritance, then the period of holding shall be considered from the previous owner. So in our example, okay, in this example number 4, the period of holding will be considered from the father. Okay, irrespective, father has transferred the asset to this assessee Mr. Radhe in the financial year 2011 and 12. Okay, as per section 49 that we have studied over here, if an asset is received as a gift, okay, then the period of holding shall be considered from the previous owner. I hope this is quite clear. And the cost of acquisition of such property that has been received as gift should be considered from the previous owner only. So that means cost of acquisition is equal to cost of previous owner plus cost of improvement of the previous owner, if any. I hope this is quite clear to you all. So come into the example again. Okay, so over here in example number 4, the example number 4 says that Mr. Radhe received a gift of house property from his father in the financial year 2011 and 12. And the father purchased this house property in the financial year 2002 and 3 at the rate 12 lakhs. I hope this is quite clear. Mr. Radhe sold this house property in the financial year 2019-20. So basically, the period of holding will be how much? The period of holding will be from 2002 to 2003 to 2019 and 20. I hope this is quite clear to you all. So basically, if the house property is there, house property falls in the range of 24 months criteria. So in order to identify whether this house property is a long-term capital asset or a short-term capital asset, we have to see that whether the period of holding is more than 24 months or less than 24 months. So as we can see that the father has purchased this house property in the financial year 2002-3, okay, and the asset has been sold in the financial year 2019-20. So it is easily more than 24 months. Okay, so over here in period of holding, we will write more than 24 months. Okay, taken from previous owner. I hope this is quite clear to you all. Okay, so the next thing what we will do is, since we have already identified that the period of holding is more than 24 months, so that means this capital asset, which is a house property, is a long-term capital asset. So which format we will use? We will use this format, that is computation of long-term capital gains format. I hope this is quite clear. And the next thing after considering the format we will do is we will calculate full value of consideration. So over here, the question specifies that Mr. Radhe sold this house property in the financial year 2019-20 at the rate rupees 60 lakhs, and the stamp duty value as per the stamp duty valuation authority is rupees 65 lakhs. So section 50C will get trigger over here. So how we will calculate the full value of consideration? We will calculate full value of consideration in this manner. So stamp duty value will be compared with 105% of actual consideration. Okay, so stamp duty value is 65 lakhs and 105% of 60 lakhs is equal to, let's find that out, 60 lakhs into 105% is equal to 63 lakhs. Okay, so since you can see that stamp duty value is more than 105% of the actual consideration, then full value of consideration is equal to stamp duty value, which is equal to 65 lakhs. I hope this is quite clear. So in our solution, that is in our format book, we will write over here as 65 lakhs. I hope this is quite clear. And let's see what the question has asked us to do. question has asked us to calculate the capital gain on the same. So over here we will consider two methods, that is one is indexation method and one is without indexation method. Okay, because the question has not provided any detail about this exemption under section 54 to 54 GB. I hope this is quite clear to you all. So we will mention over here also 65 lakh. Okay, and the next thing in the format is transfer expenses. So is there any transfer expenses given in the question? So the answer is yes. So let's come into the example number 4. Transfer expenses, that is brokerage at the rate 5%. So on what this 5% will be calculated? This 5% will be calculated on the actual consideration that has been received by the assessee, that is Mr. Radhe. So we will write it over here, 5% of the actual consideration, that is 60 lakhs. So how much is that? It will be equal to 3 lakhs. I hope this is quite clear to you all. Okay, so 3 lakhs in both the cases. Okay, and net consideration will be equal to 62 lakhs in both the columns. I hope this is quite clear to you all. Okay, and then the cost of acquisition of this property is given to us. Okay, the cost of acquisition of the property is given to us, that is father has purchased such house property at the rate 12 lakhs. So let's again come to section 49. Okay, so come over here. In section 49, in point number 2, when the asset is transferred as a gift, period of holding shall be considered from the previous owner. Okay, and similarly, cost of acquisition will also be considered as per the cost of previous owner plus cost of improvement of the previous owner. Okay, in this example number 4, the cost of acquisition will be equal to 12 lakhs. Okay, so in this column where indexation is not followed, okay, that is without indexation we are solving. So the cost of acquisition, we will simply mention it over here as 12 lakhs. I hope this is quite clear, and there are no details of cost of improvement, so we'll put a dash. And finally, the gross long-term capital gain will be equal to 50 lakhs. I hope this is quite clear to you all. And finally, there are no details about the exemption, so we will put a dash. And finally, long-term capital gain is equal to 50 lakhs. Okay, so let's calculate the index cost of acquisition for this column when indexation is followed. Okay, so let's calculate that. We will calculate it over here only. Okay, so the cost of acquisition of the property by the father was 12 lakhs. Okay, and the index cost of inflation for the date of transfer is 289, that is the previous year 2019-20. Okay, that is what we have seen in this indexation table. Okay, for 2019-20 cost inflation index is 289. I hope this is quite clear to you all. Okay, so let's come back to the notes in example number 4. And the father has purchased such house property in the financial year 2002 and 3. Okay, we have to consider the index cost of inflation of the year of acquisition, that means of the year 2002 and 3. I hope this is quite clear. So let's come back to the study material. In the financial year 2002 and 3, the cost of inflation index is 105. Okay, so we will divide it by 105 and finally we will find out the index cost of acquisition. I hope this is quite clear. So 12 lakhs into 289 divided by 105, which is equal to 33 lakhs 2,857. So this is what we will take it over here, 33 lakhs 2,857. I hope this is quite clear. So and then we will find out our gross long-term capital gain, 62 lakhs minus 33 lakhs 2,857, which is equal to 28 lakh 97,143. Okay, and no detail of exemptions are given, so we'll put a dash over here. Okay, and finally we will calculate our long-term capital gain, which will be equal to 28 lakh 97,143, and on this we will calculate the tax. Okay, so 28 lakh 97,143 into 20% will be equal to 5 lakh 79,428. Okay, and 10% tax will be calculated, which will be equal to 5 lakhs. So which method is better? So as you can see in this comparative view, definitely without indexation method is better, because the final tax liability is lower as compared to following the indexation method. I hope this is quite clear. So finally, what we wanted to study in this example, we wanted to study that section 49 says that we have to calculate the period of holding of a particular capital asset from the previous owner, as well as we can take the cost of acquisition of the previous owner only. if such capital asset has been received by the assessee as a gift. Okay, so basically we need to study this entire table, that is entire section 49. Okay, we have just studied only this part, which says that if the asset is transferred under a gift or under a will or under inheritance, then the period of holding shall be considered from the previous owner, and the cost of acquisition shall be considered of a previous owner plus cost of improvement of the previous owner. So basically this gift refers to income from other sources gift, where we have studied that if an assessee receives a gift from Ram D. Hutt Lee Ji, okay, then it is exempted under section 56 subsection 2 subsection 10. I hope you remember this part. I hope this is quite clear to you all. So basically for that purpose this particular point is there. I hope this is quite clear. So our example number 4 also comes to an end. Okay students, so now let's start with our next section, that is section 49, which talks about determination of a period of holding and actual cost. Okay, the stuffs that you are seeing highlighted in this table are of utmost importance at your CA IPC level. Okay, the stuff that has not been highlighted is important at CA final level. Okay, but they are given in your syllabus, that's why I'm covering it. But I have very less hope that questions from this unhighlighted part will come, because it is all related to companies or some other part which is not covered in IPC level. Okay, so whichever part I have not highlighted, you do not dare to skip that part. You have to study it, because it is any which was given in your syllabus. You need to be aware of this, because they may ask a question from this in the MCQ. Okay, but for the highlighted part, do not dare to make a single mistake, because they usually put a question from this highlighted parts only. Okay, so let's understand it from the highlighted part first. Point number 2 says that asset transferred under will, gift, inheritance from the relative, then the period of holding of such gift or capital asset will be taken from a previous owner. I hope this is quite clear to us why the period of holding is calculated, in order to identify that whether a capital asset is a long-term capital asset or a short-term capital asset. And finally, with the help of that, we will derive long-term capital gain or short-term capital gain. I hope this is quite clear to you all. And the cost of acquisition in this case will be the cost of acquisition of the previous owner will be taken, plus the cost of improvement of the previous owner will also be considered in the cost of acquisition. I hope this is quite clear to you all. So now let's come to point number 5. Point number 5 talks about bonus share. Okay, you just need to understand it, because we have not studied the shares part yet. Okay, but it is very easy, you will understand it. Okay, so point number 5 talks about bonus shares. In order to calculate the period of holding of the bonus shares, the period of holding will be considered from the date of the allotment till the date of selling. I hope this is quite clear to you all. If acquired after 1st April 2001, cost of acquisition will be nil, and if acquired before 1st April 2001, then the cost of acquisition will be fair market value as on 1st April 2001. I hope this is quite clear to you all. Don't worry, we will come to this part again when we will be studying shares. Okay, that is equity shares part, which is also a capital asset. Okay, don't worry, let's revise this part again. If an assessee has received a bonus share, the period of holding of such bonus share will be from the date of allotment till the date of selling. Okay, and the cost of acquisition of such bonus share will be, if acquired after 1st April 2001, then the cost of acquisition will be nil, because bonus share is given free of cost, okay, to the shareholders. I hope this is quite clear to you all. For this bonus shares, the shareholder has not paid a single rupee. I hope this is quite clear. And if the acquisition of this bonus share is done before 1st April 2001, then the cost of acquisition will be fair market value, that is the fair market value of this bonus share as on 1st April 2011. So these details, okay, the details of the fair market value of this bonus share on 1st April 2001 will be given in the question. You don't need to calculate it. Okay, so don't worry about that. Okay, the next point is point number 6. Point number 6 talks about right share. Okay, so basically company issues right shares. Okay, so we have already studied renouncement. Okay, that is relinquishment of the right of a capital asset in separate. Okay, while studying this section 2 subsection 47. I hope this is quite clear to you all. The period of holding such a right share is from the date of allotment of the right share. This is the right share. That means the assessee has applied for issue of right share at the rate discounted price. I hope this is quite clear to you all. And this is right shares, okay, and not only right. I hope this is quite clear. The period of holding of this right equity shares is from the date of allotment of the right shares, and the cost of acquisition for the original shareholder is cost of acquisition is equal to discounted price of the right shares. Otherwise, that means if this right shares has been purchased by a third person, then the cost of acquisition to this third person will be purchase price plus amount paid for renouncement. I hope this is quite clear to you all. This we have already studied what does renouncement means. Okay, so let's revise this part again. Point number 6 talks about right shares. In order to calculate the period of holding for this right equity shares, the period of holding will be considered from the date of allotment of the right shares. Okay, and if such right shares are allotted to the original shareholder who has received the right from the company, then the cost of acquisition of such right equity shares is discounted price of the right issue. Otherwise, that means if a third person has purchased the right from this original shareholder, okay, then for this third party, the cost of acquisition will be purchase price that he has paid to the company plus the amount paid for the renouncement. I hope this is quite clear to you all. Then 7th point is about renouncement of the right. Okay, so we have already studied about this in relinquishment of the right in a capital asset. The period of holding of the renouncement of the right is from the date of the offer made by the company. Basically, this will be short term only. Okay, and the cost of acquisition will be nil. So finally, whatever the capital gain has been derived, it will be short term capital gain only, because basically the company gives the right option, okay, to the shareholders for a period of say 1 month to subscribe to such issue, or say of 3 months. Okay, and this 1 month and 3 months is any which ways lesser than the all the three ranges, that is 12-month range, 24-month range and 36 months range. I hope this is quite clear to you all. So that's why this renouncement of the right period of holding is irrelevant. Any which ways it will be short term only. Okay, and finally the capital gain on such renouncement of the right will be short term capital gain only. I hope this is quite clear to you all. And the cost of acquisition of this renouncement of right is nil. Okay, because assessee has not purchased the right. Okay, he has received the right from the company and he is selling it to a third party, and whatever the amount has been received by this third party to the original shareholder, it will be considered as full value of the consideration and there will be no cost of acquisition. I hope this is quite clear to you all. So let's understand point number 8. Point number 8 says that ESOP, sweat equity shares. So if an assessee has ESOP or sweat equity shares, then the period of holding of such ESOP or sweat equity shares is from the date of allotment of such ESOP or sweat equity shares. I hope this is quite clear. And the cost of acquisition of this ESOP or sweat equity shares is FMB taken while calculating the perquisites. I hope this is quite clear to you. So basically what this part is relating to income from salary. I hope this is quite clear to you all. Okay, so any which ways this is a very rare possibility to ask question on this, but still it is given in the syllabus, that's why I'm keeping it over here. These details will be given to you. You don't need to calculate the value of the perquisite. Okay, so let's revise point number 8. Point number 8 says that ESOP or sweat equity shares, if received by the assessee from the company, then the period of holding of such equity shares will be from the date of allotment of such ESOP or sweat equity share, and the cost of acquisition of this ESOP or sweat equity shares will be FMB taken while calculating the perquisite, and these details will be given in the question. I hope this is quite clear to you all. So let's move on to the next page. Okay, here point number 11 is important at your level, because this point says that if property, what is saying, if property is received by way of gift from any other than relative, okay, then since he has received a property gift from other than Ram D Hattali Ji, okay, then whatever amount of gift, that is the property's value, will be considered in this section, that is section 56 subsection 2 subsection 10, and whatever the amount is calculated, it will be considered in the head income from other sources. I hope this is quite clear. So if this property has been received as a gift by an assessee other than a relative, then the period of holding of such property will be from the date of such gift received, and cost of acquisition of such property will be value taken under section 56 subsection 2 subsection 10 for calculation of the tax. I hope this is quite clear. So indirectly in income from other sources, what they are telling is why someone else will give you a property free of cost. That means you have somehow paid to him, but you are not showing under income tax. That's why they have valued the property as per this section, that is under section 56 subsection 2 subsection 10, and whatever value has been considered, and on this value the taxes has been calculated. So this value as derived by under section 56 subsection 2 will be considered as the cost of acquisition of this property which has been received as gift by this assessee, okay, from any other person other than the relative. I hope this is quite clear to you all. Okay, so all the important part for CA IPC level is complete. Okay, so we need to understand all the points which I have not highlighted. Okay, so let's start with point number one. Point number one says that shares in company which is in liquidation. Okay, so basically this is also considered as a kind of transfer only. A share is there in a company and such company is getting liquidated, and since the company is getting liquidated, the company will pay back the shareholders. Okay, so this is also considered as a transfer by the assessee. I hope this is quite clear. So the period of holding will be calculated in this manner for the shares of the company who is getting liquidated. So date of acquisition of the shares, if it is in the year 2004 and 5, okay, and the date of the liquidation of the company is in the financial year 16-17, then the period of the holding will be considered up to this much only. I hope this is quite clear to you all. And the actual amount has been received in the year that is 1920, that is the previous year 2019-20. So in this year 1920 it will be taxable, and the period of holding will be calculated up to this period only. Okay, since we already know that shares fall in the range of 12 months category, okay, then if we have to find out whether this share which is a capital asset, is this capital asset is a long term capital asset or a short term capital asset, we have to see that whether the shares have been holded for a period of more than 12 months or not. So since we can see that the date of acquisition of the share is in the financial year 2004 and 5, and the date of liquidation of the company is in the year 16-17, so any which ways it is more than 12 months. I hope this is quite clear. And the cost of acquisition of the shares will be actual cost of such shares on the date of acquisition. I hope this is quite clear to you all. Okay, so please do not stress on it. It is any which ways made in a very simple format so that you can understand it. Okay, but there is a high possibility that questions from this can be asked in a MCQ. I hope this is quite clear. So now let's move on to point number 3. Point number 3 says that if an inventory is converted into a capital asset, understand that this is a assessee. Okay, this assessee is a businessman. Okay, and this assessee is doing a business of house property. So all this house property will be the inventory of this assessee. I hope this is quite clear. So if this assessee converts this inventory into a capital asset, and this converted capital asset at a later date is sold, then on this capital asset capital gain will be generated. I hope this is quite clear. So that's why period of holding will be important in order to identify whether long term capital gain will be generated or short term capital gain will be generated. So how to calculate the period of holding? Period of holding will be calculated in this manner. From the date of such conversion into the capital asset till the date of sale will be the period of holding. I hope this is quite clear to you all. Cost of acquisition will be fair market value on the date of such conversion. That means this inventory's fair market value on the date of conversion will become the cost of acquisition of such capital asset which got converted. I hope this is quite clear to you all. So let's move on to point number 4. Point number 4 says that shares received in an amalgamating company. This is a very high possibility that it will not come in your exam, but we need to study that. Okay, if a share is received in an amalgamated company, this share is also a capital asset. So we need to find out the period of holding of such capital asset. The period of holding will be from the date of acquisition of the shares in the amalgamating company to till date. So here it is written amalgamating company. You will not understand this part right now because we have not studied section 47. After studying section 47 you will understand it, but in order to complete the explanation I'll explain it to you over here. Okay, in point number 4, share is received in an amalgamating company and period of holding will be taken from the date of acquisition of a share in the amalgamating company. So I'll give you a broad view. So this is our old company, company A. Okay, this company A and company B are getting amalgamated together. Okay, so basically the assessee was holding shares in this company A, but after getting amalgamated with company B, okay, company B is transferring the shares of company B to the shareholders of company A. Okay, so whatever shares have been received by the company A shareholders and such shares are of the shares of company B. So whatever shares of company B have been received by the shareholders of the company A, it will be considered as the capital asset of the assessee. So if at a later date when the assessee wants to sell the shares of company B's shares that he has received during amalgamation, okay, the period of holding of such company B shares will be in this manner. Okay, that is what is given over here. Period of holding will be from the date of acquisition of the shares in the amalgamating company. So in our case, the amalgamating company was company A and amalgamated company was company B. So the date when the assessee has purchased the shares in the company A will be considered as the date of the acquisition of the shares, okay. And finally, the period of holding will be considered from the date of acquisition of the shares in the amalgamating company till the date of sale. I hope this is quite clear. And similarly, cost of acquisition will be equal to shares acquired in the amalgamating company, that is the old company. I hope this is quite clear to you all. Okay, so now let's move on to next page and understand point number 9. Point number 9 says that shares in resulting company due to demerger. This also point is covered under section 47. Okay, so don't worry about that. We will study section 47 at the end because it is very simple. Okay, it is really very simple. But I'll explain you this part over here also, and at the time we are understanding section 47, at that time also I'll again explain to you all. Okay, so don't worry. Okay, so now let's understand point number 9. Point number 9 is about shares in resulting company due to demerger company. So I have to explain you this part with the help of an example. So come over here in a blank page. Understand this. This is a company. Okay, this company has a 4 unit. This is company A, and this 4th unit has been transferred. Okay, and it is becoming company B. So a shareholder is holding shares in company A. Since this company part 4 is getting demerged and forming company B, this company B will issue shares to the shareholders of the company A. I hope this is quite clear to you. So whatever the shares have been received by the shareholders of company A from this company B due to this demerger, okay, due to this demerger, then whatever shares has been received from this resulting company. So company B will be the resulting company and this is a demerger company, okay. So that is what is given in this note. If the share in the resulting company is received due to a demerger, then the period of holding of such share in a resultant company will be calculated in this manner. Period of holding of such share is from the date of acquisition of the share in the demerged company. That means this original A company, okay. I hope this is quite clear to you. So let's come back to the notes, okay. And similarly, cost of acquisition of the shares in the resulting company will be in this manner. Cost of acquisition of the shares in the demerger company into net book value of the shares transferred to the resulting company divided by the net worth of the company before demerger. I hope this is quite clear. Cost of the shares in the demerger company will be calculated in this manner. Cost of the demerger company shares minus cost of the shares in the resulting company. This is a very high possibility it will not come at your level. This is specifically at CA final level asked questions. So if you want, you can skip this part, but if you have understood it, please do not skip it. Even there is a very rare possibility that they will ask this question in MCQ also, okay, because company is not any which way part of your syllabus at CA IPC level. I hope this is quite clear to you all. Okay, so let's move on to point number 10. Point number 10 says that shares or debentures acquired due to conversion of bonds, debentures or debenture stock or deposit certificate, then how to calculate the period of holding of such shares or debentures which have been acquired due to such conversion. So period of holding will be equal to from the date of which such bonds, debentures or debenture stock or deposit certificate was originally acquired. I hope this is quite clear. And cost of acquisition of such asset, that means this share or debenture, will be cost of such bonds, debenture or debenture stock or deposit certificate was acquired. Originally this were acquired and the company converted this and gave them shares or debentures, okay. So if this is the case, how to calculate period of holding and how to calculate cost of acquisition, that is what is given over here. I hope this is quite clear to you all, okay. So let's move on to point number 12. Point number 12 says that asset disclosed under the income disclosure scheme 2016. So basically during the time of demonetization, okay, you have heard that the government, that is the income tax department, has given the option to the assessees that bring all the old 500 notes that you have not disclosed to the government and we will charge a certain percentage of tax and we will consider it as okay and we will not charge any penalty, and the rest amount, okay, that is the rest money that you have, it will be considered as proper money, that is white money. I hope this is quite clear. If during that time of demonetization, if the assessee has disclosed any asset which he has never disclosed earlier to the income tax, okay, then the period of holding of such asset will be from the date of commencement of the scheme, that is 1st June 2016 till the date of sale. That means, for example, understand that on 1st June 2016, the assessor disclosed to the income tax department that he is having a particular asset. Okay, so after disclosing, the income tax department charge him a certain percentage. For example, they charge him a 50% tax flat, okay, without considering any exemption deduction at all. Okay, so after that, this property, that is the asset, is considered as white asset. Okay, so that means this asset is now in the books of the assessee. So at a later stage, when the assessee wants to sell this asset which has been disclosed under the income disclosure scheme 2016, the period of holding will be required. Okay, so in order to calculate period of holding, this is given. Okay, so period of holding will be considered in this manner from the date of commencement of the scheme, that is 1st June 2016 till the date of sale. I hope this is quite clear to you all. Then how to calculate the cost of acquisition? The cost of acquisition in this case will be calculated in this manner. FMV of the asset taken into account for the purpose of the said scheme. For example, understand that the asset disclosed by the assessee was say of rupees 1 crore. On this, the government charged him a 50% tax. Okay, so the tax is equal to 50 lakhs, but the cost of acquisition of this property will be fair market value of the asset taken in the account for the purpose of the said scheme. That means 1 crore will be allowed as cost of acquisition. I hope this is quite clear to you all. Okay students, so now let's understand point number 13. Point number 13 says that equity shares acquired on conversion of the preference share. So basically assume that in this company, the preference shares holder are there. Okay, so company is offering this preference shareholder to get converted into equity shareholder. Okay, so this preference shareholders will receive equity shares. I hope this is quite clear to you all. This is what is given over here. So if an assessee who was holding a preference share, okay, and he has paid for the preference share, okay, and at a later stage the company gave the preference shareholder equity shares, and the assessee now wants to sell this equity shares. So how the period of holding will be ascertained? The period of holding will be ascertained in this manner. The period of holding will be taken from the date of acquisition of this preference shares only, and the cost of acquisition of this equity share will be value of the preference shares when the assessee has taken the preference shares of that company. I hope this is quite clear to you all. Okay students, so now let's understand this note. In order to understand this note, we need to revise this point number 2 again. Point number 2 says that asset transferred under will, gift, inheritance from the relative, then the period of holding of such asset will be considered from the previous owner. Okay, and the cost of acquisition of such asset to this current assessee will be considered as in this manner: cost of the previous owner plus cost of the improvement of the previous owner. I hope this is quite clear, and here I have written a note. Okay, so we need to study this note. What does this note says? As per the case of Manjulal J. Shah, which was further held by Bombay High Court, it was decided that cost of acquisition in case of a gift, will, inheritance will be taken from the previous owner. So that is what is given over here. Okay, but why it is given over here? Because of that case law. Because of which case law? Because of the case law of Manjulal J. Shah. I hope this is quite clear. If the gifted asset is acquired by the previous owner before 1st April 2001, then the cost of acquisition will be calculated in this manner: fair market value of such gifted asset on 1st April 2001, or actual cost of acquisition, whichever is higher, will be considered as a cost of acquisition. I hope this is quite clear. And this rule, basically this rule, cost of acquisition rule, applies to the assessee who has acquired the asset before 1st April 2001. So simply understand it in a blank page. Okay, so here is our assessee. Okay, and this assessee has received gift of flat gift of flat from father. Okay, and father has purchased house property on 1st April 2000. Okay, for rupees 3 lakhs. I hope this is quite clear to you all. And the fair market value of this house property on 1st April 2001 is rupees 4 lakhs. Okay, so the cost of acquisition to this assessee will be in this manner. Okay, fair market value or the actual cost, okay, whichever is higher, that is 4 lakhs or 3 lakhs, whichever is higher is 4 lakhs. So cost of acquisition will be 4 lakhs. I hope this is quite clear to you all. Similarly, so understand that if this assessee has himself purchased the house property on 1st April 2000 for rupees 3 lakhs, okay, and the fair market value of this house property on 1st April 2001 is 4 lakhs, then the cost of acquisition to this assessee will be 4 lakhs. I hope this is quite clear. How I have calculated this 4 lakhs? I have calculated it with this formula, fair market value or actual cost, whichever is higher. I hope this is quite clear. So that is what is given in the notes in the second point, okay. I hope this is quite clear. So over here, this note is an important note. I know I have told you earlier in the initial parts of the video that at your level, that is CA IPC level, case laws are of not so much important, but there are few case laws that you have to study at your level also. So this is that case law, okay. So what does this case law says that as per the case of Manjulal Jesha, which was further held by Bombay High Court, it was decided that cost of acquisition in case of a gift will inheritance will be taken of the previous owner only. I hope this is quite clear. So whenever you are solving a sum on this particular point, okay, then you have to mention this case law in the notes. I hope this is quite clear to you all, okay. So section 49 also comes to an end, okay. Okay students, we have already studied this section 49. What we have studied under this section 49, we have studied how to determine the period of holding and how to determine the cost of acquisition, that is the actual cost. So on the similar lines of this section, that is section 49, there is one more concept of self-generating asset, okay. So let's study that concept. Come on the page where exemption under section 10 is given under this chapter, okay. Below there is a self-generated assets chart, okay. If there is a self-generated asset and the self-generated asset is a turtle G, what does turtle G means? Turtle G stands for tenancy right, R stands for root permit, R2 stands for right to manufacture articles or thing, T stands for trademark, brand name, etc. L stands for loom house, G stands for goodwill of the business. So if this all are the capital asset and such capital asset are self-generated asset, okay, and if the assessee transfers this capital asset, then on such transfer of the capital asset, the assessee will generate the capital gain, and on such capital gain, the assessee will have to pay the taxes. I hope this is quite clear. So if this asset, that is a self-generated asset, is generated, then what will be the cost of acquisition of this self-generated asset? The cost of acquisition of this self-generated asset will be nil. I hope this is quite clear. But the capital gain will be calculated on this turtle G. I hope this is quite clear, because the assessee has received the consideration, and on such consideration the capital gain will be calculated and the cost of acquisition will be nil. I hope this is quite clear. But if there is any other asset other than this turtle G, that means tenancy right, root permit, right to manufacture articles or thing, trademark, brand name, etc., loom houses, goodwill of the business, then no capital gain will be calculated. I hope this is quite clear to you all. So let's understand what does tenancy right means. So basically in Mumbai there is a system known as Pagadi system, okay. In this Pagadi system there is a landlord, okay, and the landlord has created a building, and in this building there are different units, okay. For example, this is 6 unit, okay. So basically what happens is, this unit holder, if he wants to sell his unit, that is his house property, to any other person, then this unit holder has to pay the owner, that is this owner, a 1/3 of the amount that he is going to receive from this other person, that is the third person. I hope this is quite clear, because this owner who is having this 6 units, okay, who is a landlord, he is having a tenancy right, okay. So in Mumbai it is known as Pagadi system. In other parts of India it may be known by different name. So that's why I'm explaining you what happens in a Pagadi system. So basically, if the owner who is having a unit, that is a property in this building which is owned by a landlord, okay, owned by a landlord, and this unit holder wants to sell his property to any other person, okay, then whatever consideration he will receive from this third person, 1/3 of the amount he has to pay it to the landlord. I hope this is quite clear. So if the landlord is receiving this 1/3, it will be considered as tenancy right received, okay. And when the tenancy right has been received, it will be considered as income from capital gain, and it will be taxable. I hope this is quite clear. And the cost of acquisition of this tenancy right will be nil. I hope this is quite clear. Okay students, so now let's understand what does root permit means. Root permit means, can be simply understand in this manner. This is a factory owner, okay, and factory owners have this much land, okay, and they have created a road in their premises, okay, and this road connects two places, okay. So the government has asked this factory owners to open this land, open this road for the general public also, okay. In return, the factory owner will receive a route permit fees. I hope this is quite clear. So whatever route permit fees has been received by this factory owner for allowing that road to be used by the general public will be considered as capital gain. I hope this is quite clear, and it will be chargeable under the head income from capital gain. I hope this is quite clear. Right to manufacture article or thing, it is simply like patents. Okay, trademark and brand name, it is quite self-explanatory. So let's move on to point number 5. Point number 5 is also quite self-explanatory, that is loom houses. And point number 6 is also quite self-explanatory, that is goodwill of a business. Only these 2 points people do not understand easily, so that's why I explained it. So I hope you all have understood this self-generated asset. Okay students, now come on the very first page of the notes of income from capital gain. Here we have studied this first section, that is section 45, which is a charging section. Okay, and we have studied this formula. This formula was that capital gain will get triggered under section 45 subsection 1 only when there is a capital asset as per the definition given under section 2 subsection 14, plus such capital asset should be transferred. What does transfer means? Transfer means as per the definition given under section 2 subsection 47. I hope this is quite clear to you all. But there are some special cases given under this section 45 that we need to understand. So in order to understand that special cases, we have to go into our format book, because such cases are a format based cases. Okay, so understanding it in a format book is quite appropriate. Okay, so now let's come to the third page of the format book, and from here our special cases under section 45 starts. I hope this is quite clear. This is our very first special case which talks about section 45 subsection 1a, insurance compensation. We will firstly read out this much and then we will understand why this particular provision came into existence. Okay, so the point 1 in this section 45 subsection 1a says that insurance claim received on destruction, damage of the capital asset, then such compensation shall be taxable under the capital gain. Okay, what does destruction and damage means? The destruction and damage caused to this capital asset due to the fire, due to floods, or due to typhoon, due to tsunami, earthquake, natural calamities, riots, civil destruction, war, action of the enemy, then the compensation actually received by the owner of such capital asset, and whatever compensation has been received by this owner will be considered under the head income from capital gain. I hope this is quite clear to you all. Okay, so now let's understand why this section 45 came into picture. Understand this. This is a assessee. Okay, this assessee is having a villa. Okay, and this villa is covered with insurance. Okay, and this owner wants to sell this villa. Okay, but he is not getting any buyer. Okay, so what this owner does is he simply puts his villa on fire. Okay, which is a part of destruction or damage to the capital asset. Okay, since the owner has set his villa, okay, on fire and showed to the insurance company as an accident. Okay, and the insurance company will now pay this owner a insurance compensation. I hope this is quite clear to you all. Okay, so when the insurance company is paying the insurance compensation to this owner, so the government is saying that even though the assessee is showing that this villa was destroyed due to damage, but the actual reality is this assessee has himself destroyed this villa just because he was not getting any buyer, and he is trying to receive his money from the insurance company. So basically he is trying to sell this house property only. So whatever the compensation, okay, compensation has been received from this insurance company, okay, will be considered as a full value of consideration received by this assessee, and such full value of the consideration will be chargeable, okay, under the head of income from capital gain under section 45 subsection 1a. I hope this is quite clear. In the starting you all might be thinking it is quite illogical, because if an assessee is receiving an insurance compensation from an insurance company due to there is a damage or destruction to the capital asset, okay, so you all might be thinking this is an injustice on the assessee since he is receiving a compensation, so why that compensation will be chargeable to tax under the head income from capital gain. But the ground reality is many of the times it has been seen that the assessee was himself involved in the damage and the destruction of such property, okay, but the insurance company could not found that mischief done by the owner. I hope this is quite clear to you all. So the full value of the consideration in this case will be insurance compensation received by the insurance company. I hope this is quite clear, and the method of calculation of the capital gain is given below. Okay, so before understanding the method of calculation of the capital gain, there is a common thing that we need to write as we have studied earlier in this parts also. Okay, So we need to mention there name of the assessee, residential status of the assessee, period of holding of such capital asset, and what is that capital asset, whether such capital asset is a long-term capital asset or not. And then we have to mention these details also primarily, that is assessment year as well as the previous year. I hope this is quite clear to you all. Okay. There are two methods. Okay, method A is for a capital asset which is a non-depreciable asset which got damaged in such destruction. I hope this is quite clear to you all. And method B is when the capital asset which got damaged is a depreciable asset. I hope this is also quite clear to you all. So let's understand method A. Okay, when a capital asset got damaged and such capital asset is a non-depreciable asset. So for example, understand that this is a house property, for example the villa only. Okay, this is the villa of the assessee. Okay, and this villa is holded by this assessee for a period of more than 24 months. So primarily this villa, which is a house property and a capital asset, such capital asset is a long-term capital asset. I hope this is quite clear. So we will finally calculate a long-term capital gain. But for example, understand that this villa, okay, is a capital asset firstly, and it has been holded by the assessee for less than 24 months. Okay, then this capital asset will be short-term capital asset, and on such capital asset we will calculate short-term capital gain. I hope this is quite clear. But if the capital asset is a long-term capital asset, then the assessee has the option of indexation, as well as he has the option not to opt for indexation. I hope this is quite clear to you. So basically, to opt for indexation, it is at the discretion of the assessee. I hope this is quite clear to you. Only when such capital asset is a long-term capital asset. I hope this is quite clear. So let's understand this point here. When a capital asset which is damaged is a non-depreciable asset. So firstly we need to find out full value of consideration. How we will find out full value of consideration? Full value of consideration will be simply equal to insurance compensation received by the insurance company. So we'll mention this full value of consideration over here. Okay, and then we will further reduce the transfer expenses if any given in the question, and finally we will find out our net consideration. We will reduce index cost of acquisition if the assessee follows indexation method. I hope this is quite clear. But if the assessee does not wants to follow indexation method, okay, does not wants to follow indexation method, then we will mention cost of acquisition. But for example, understand that if a capital asset is a short-term capital asset, then there is no question of indexation. We have to mention only cost of acquisition and cost of improvement only. I hope this is quite clear. So you all might be wondering, how come cost of improvement will be taken over here? So it is very simple. Understand that this is a house property. Okay, if the assessee had made any renovation to this house property, he will get cost of improvement also. Okay, so do not think that if a asset which is a capital asset which has got damaged, so on that how come cost of improvement will be possible? Cost of improvement will be possible if such capital asset is a house property. I hope this is quite clear to you all. Okay, and finally we will find out a gross long-term capital gain, and this gross long-term capital gain can be further reduced with the exemption under section 54 to 54 GB. I hope this is quite clear to you all. Okay, and then if the asset is a long-term capital asset, then we will find out long-term capital gain. But if the asset is a short-term capital asset, then we will find out short-term capital gain. I hope this is quite clear. If the asset is a long-term capital asset and indexation is been followed, then the rate of tax will be 20%. But if the indexation is not followed, then the rate of tax will be 10%. And if the asset is a short-term capital asset, then the tax rate will be slab rate. Okay, I hope this is quite clear to you. So we have revised the rates of taxes also on such capital gains. I hope this is quite clear to you. But if in the method 2, when the capital asset which got damaged is a depreciable asset, so how we will calculate the capital gain? So firstly understand that if a capital asset which got damaged is a depreciable asset, then on such capital asset only short-term capital gain is possible, irrespective the period of holding is more than 36 months. I hope this is quite clear to you all, because for example understand that a depreciable asset can be a plant and machinery, and even if such asset has been holded for a period of 36 months, okay, still we will calculate short-term capital gain only. It is a part of this method only. Whenever you will study income from PGBP, that is business and profession, that time we will study a depreciation chart. That time you will come to know why we are calculating short-term capital gain. Okay, but for time being understand that if a capital asset which got damaged, okay, and an insurance compensation is received, and such capital asset is a depreciable asset, then on such capital asset which is a depreciable asset, we can only find out short-term capital gain irrespective of the period of holding. I hope this is quite clear. And the method of calculating short-term capital gain is as follows. Full value of consideration simply means whatever the amount has been received from the insurance company, which will be further reduced by the WDV of a depreciable asset as per the Income Tax Act. That means whatever will be the WDV of the asset, that is a depreciable asset, as per Income Tax Act, that we will consider over here. Okay, and finally, if the value is positive over here, okay, then it will become short-term capital gain. But if the value is negative, okay, that is the difference of this two is negative, then such negative figure will be known as terminal depreciation. I hope this is quite clear to you all. Okay, so there is a note, and this note is very important. Okay, I have written the dates over here. Okay, but in your notes, whatever you have received, there is a blank space over here. Okay, if you want, you can copy it, but I'll recommend you do not copy it right now, because this is a part of this format only. Okay, but I have written it over here because I wanted to explain you something. That's why I've already written it. Okay, so the note says that asset acquired on financial year 2005 and 6, and such asset got damaged on 2014 and 15, and the compensation received on such damaged asset is on 2019-20. So basically, when such compensation will be taxable, the compensation will be taxable in the assessment year 2020-21. That means in the previous year 2019-20. I hope this is quite clear. And the indexation will be taken up to the financial year 2014 and 15. That means up to the time when the asset got damaged. Okay, and the period of holding will be calculated from the actual date of purchase till the date of damage. That is what only it is given over here. Okay, so let's come to a blank page. I'll explain it to you over here. Understand that a capital asset is there. Okay, purchased in 2005 and 6. Okay, at the rate 10 lakhs. I hope this is quite clear. Got damaged in the financial year 2014-15. Okay, compensation received in 2019-20 at the rate rupees 60 lakhs. Transfer expenses nil. Okay, and exemption detail also nil. I hope this is quite clear to you. So on this, how we will calculate capital gain? Okay, so let's see that. Since you can see this capital asset is there, so I have not mentioned what is this capital asset. This capital asset we will assume to be a house property. That means it is a non-depreciable asset. I hope this is quite clear. So we will follow method A. Okay, so in method A, we will firstly write full value of consideration. What is the full value of consideration? 60 lakhs. I hope this is quite clear. It will be further reduced by transfer expenses. Transfer expenses is 0. Okay, so we'll put a dash, and finally we'll find out our net consideration. Okay, net consideration will be equal to 60 lakhs. I hope this is quite clear. And on this net consideration, we will further reduce the cost of acquisition or the index cost of acquisition. I hope this is quite clear to you. So as you know that the period of holding we will calculate from year to year, that is from 2005 and 6 to 2014 and 15 as given in our format book in this notes. Okay, so basically what does it say? The period of holding will be from the previous year 2005 and 6 up to the previous year 2014 and 15. That means the date at which the asset got actually damaged. Okay, so let's come back to our blank page. Okay, so the period of holding for this house property can be ascertained as more than 24 months. I hope this is quite clear. So basically we will find out long-term capital gain, and indexation option is also available to the assessee, and this assessee opts for indexation also. So let's calculate indexation now. So indexation will be calculated in this manner. Index cost of acquisition, original cost of the asset is 10 lakhs. Okay, into, so what does our format book note say? The note says that indexation will be calculated up to financial year 2014 and 15. That means, understand that in the numerator what we used to write is cost inflation index of year of transfer. Okay, but here we will write of year of damage. Okay, of year of damage, that is 2014 and 15, which will be further divided by cost inflation index of the year of acquisition, that is 2005 and 6. I hope this is quite clear. So let's calculate that. 10 lakhs into cost inflation index of the year of damage, and the year of damage is 2014 and 15. So now let's come back into our study material, okay, where the cost inflation index detail has been given. So the asset got actually damaged in the year 2014 and 15, and the cost inflation index is 240. I hope this is quite clear to you. So let's come back to our notes, okay, and let's mention over here 240, and further it will be divided by the cost inflation index of the year of acquisition. So the cost inflation index of the year of acquisition, that is 2005 and 6, is 117. So let's come back into our notes and let's come back into our blank page and divide it by 117, and let's find out the index cost of acquisition. So 10 lakhs into 240 divided by 117 is equal to 20 lakhs 51,282. I hope this is quite clear. So that is what the detail we will mention over here, 20 lakhs 51,282. Okay, and finally we will get our gross long term capital gain. Okay, so let's calculate how much it will be. Minus plus 60 lakhs, which is equal to 39 lakhs 48,718. I hope this is quite clear. But there are no details about this exemption. Okay, so exemption will be dash, and finally this will become our long term capital gain of 39 lakhs 48,780, and on this tax will be calculated at the rate 20%. But if this assessee, okay, if this assessee would have opted for non-indexation, then the amount of tax would have been different. So that concept we any which ways know. Okay, the primary thing that I wanted to explain you over here was this index cost of acquisition and the change in the formula. The change in the formula is cost inflation index of the year of damage, that is 2014 and 15. Okay, the actual year when the asset got damaged, and it will be further divided by the cost inflation index of the year of actually acquired. I hope this is quite clear to you all. Okay, so now let's come back to our format book. If you want, I'll put a formula also over here. In your notes, you all might be seeing it right now, but now I have not written, but I'll incorporate that formula over here. Okay, so don't worry about that. Okay, but now let's understand point number B. Okay, point number B, again we will understand it with the help of the example. Okay, over here we don't need to calculate index cost of acquisition and all. Okay, but here we need to calculate WDV of the depreciable asset as per Income Tax Act. Okay, so let's come into the blank page again. Okay, and understand this. A capital asset got damaged. Okay, and the insurance company gave a compensation of rupees 40 lakhs. I hope this is quite clear. And the capital asset is a plant and machinery. Okay, that is a depreciable asset. Okay, and the WDV of this plant and machinery is say rupees 24 lakhs. I hope this is quite clear to you all. Okay, so let's calculate the capital gain on such depreciable asset. So primarily understand that capital gain that will be calculated on this depreciable asset is a short-term capital gain because it is a depreciable asset. I hope this is quite clear to you all. So let's calculate it. Full value of consideration is equal to 40 lakhs. Okay, less will not reduce transfer expenses. Understand that. Less WDV of plant and machinery in bracket capital asset. I hope this is quite clear to you all, which is 24 lakhs. So let's reduce this, and whatever the amount is it positive or negative? So I can see it is positive 16 lakhs. Okay, so it is short term capital gain and it will be taxable at the rate slab rates. I hope this is quite clear. So what if this figure of WDV of plant and machinery would have been 44 lakhs? Okay, 44 lakhs, then how the solution would have been? The solution would have been in this manner: full value of consideration 40 lakhs, okay, and WDV of the plant and machinery 44 lakhs, okay, and here we would have derived a negative figure of 4 lakhs, okay. So this negative figure of 4 lakhs would become our terminal depreciation, okay. And on this, the assessee does not need to pay a tax. This 4 lakh, which is a terminal depreciation, it will be allowed as set off against different head of income. I hope this is quite clear. I hope you remember the set off and carry forward chapter. Okay, there we have studied depreciation, unabsorbed depreciation. I hope you remember that things. Okay, so I hope you all have understood this special case number 1, that is section 45 subsection 1, insurance compensation. So now let's revise this entire thing, that is the entire section 45 subsection 1A, insurance compensation. If an insurance claim has been received on destruction or damage of a capital asset, whether such capital asset is a depreciable asset or whether it is not a depreciable asset, okay, then such compensation shall be taxable under the head income from capital gain. I hope this is quite clear. What does destruction or damage means? Destruction or damage caused to the capital asset due to floods, fire, typhoon, tsunami, earthquake, natural calamities, riot, civil destruction, war, action of enemy. So many of the time student does not understand this word action of enemy. Action of enemy simply means war with enemy country, okay, or terrorist attack. So that is basically action of enemy. I hope this is quite clear to you all. And full value of consideration in this particular special case will be insurance compensation received by the insurance company. There are two methods. There are two methods of calculating capital gain. But before calculating the capital gain, we need to ascertain if the asset is a non-depreciable asset. Okay. So whether that asset, that means the capital asset, is a long-term capital asset or it is a short-term capital asset. I hope this is quite clear. But if a asset is a depreciable asset, okay, so we don't need to ascertain whether the capital asset is a long-term capital asset or a short-term capital asset. Okay, we just simply know that only short-term capital gain can be derived on such depreciable asset. I hope this is quite clear. If there is a positive figure, but if there is a negative figure, then it will be terminal depreciation. Okay, so now let's revise the method of calculation of the capital gain. Method number A is when capital asset damage is a non-depreciable asset, full value of consideration which will be reduced by transfer expenses, and we will finally derive a net consideration. It will be further reduced by the index cost of acquisition or cost of acquisition, and again this net consideration will be further reduced by the index cost of improvement or the cost of improvement if given in the question, and finally we will derive a gross long-term capital gain. Okay, or wait, this is very prejudicial. I have written over here gross long-term / short-term capital gain. Okay, and further we will reduce the exemption under section 54 to 54 GB if there is a long-term capital gain, but in case of a short-term capital gain we cannot reduce from section 54 to 54 GB, only we can reduce from under section 54G and GA. I hope this is quite clear to you all. And finally we will find out long-term capital gain or short-term capital gain. I hope this is quite clear to you all. Okay, so now let's revise method number B. Method number B says that when a capital asset which got damaged is a depreciable asset, then we will calculate it in this manner: full value of consideration which will be further reduced by the WDV of a depreciable asset as per the Income Tax Act 1961, and if the amount is positive it will become short-term capital gain. If the amount is negative, then it will become terminal depreciation. I hope this is quite clear. And the note says that if the asset is acquired on a particular date and the asset has got damaged before the date of compensation, then the period of holding will be taken from this 2 days, that is asset acquired date to the damage date, and whenever the compensation is received in that year only it will be taxable. I hope this is quite clear. So that is what is written over here: taxable in the assessment year 2020-21 since the compensation is received in the previous year 2019-20, and indexation will be taken up to the financial year 2014-15. Okay, and the period of holding is financial year 2005 and 6 to financial year 2014 and 15 as per the examples. Okay, I hope this is quite clear to you. Okay students, so now let's move on to the second special case, that is section 45 subsection 2, which says that conversion of a capital asset into stock in trade. So let's understand it first of all in a layman term. This is our assessee. Okay, this assessee is having 10 flats. Okay, and this 10 flats are a capital asset of this assessee. Okay, so what does this assessee is doing? This assessee is taking all his 10 flats and he is using it in his business. So basically what he is doing is converting his capital asset into the inventory of the business. Okay, so you all might be thinking, so if he is transferring the asset from himself to the business, so how will capital gain will trigger? So capital gain will be triggered in this manner because there is a capital asset first of all, and there is a transfer of a capital asset from the assessee to the business. Okay, in income tax, the income tax says that assessee is a different entity. Okay, and as well as in accounts also, the concepts in accounts also says that assessee is a different entity and a business is a different entity. I hope this is quite clear to you all. So that's why even if the assessee is himself transferring it to his business only, it will be considered as transfer only. Okay, so how to calculate the capital gain as well as the business income, that is what is given over here in this section 45 subsection 2. Okay, so point number A helps us to calculate income that will be chargeable under the head income from capital gain. Okay, and point B help us to calculate income that will be chargeable under the head income from PGPP. Okay, so we will start from the notes. What does the note says? Capital gain will trigger in the year when the capital asset which got converted into stock in trade is actually sold. And point number 2 says that the above point number A and point number B, that is this point number A and this point number B, will both happen simultaneously. The effect has to be given for the both in the year when stock in trade is sold. Okay, so let's understand it first of all in a blank page over here. Okay, so understand that this is our assessee Mr. A, who is having 10 flats. Okay, and this 10 flats has been purchased in the year 2005 and 6. Okay, at the rate rupees 15 lakhs. Okay, I hope this is quite clear. So Mr. A decides that he wants to convert his capital asset into the inventory. Okay, into the inventory of business in the year 2018-19. Okay, and this inventory, okay, that means the capital asset which got converted into inventory, so this inventory only is sold in the previous year 2019-20. So the note says that over here, the note says that the capital gain will be triggered. That means we will calculate the capital gain in the year when the capital asset which got converted into stock in trade is actually sold. That means whenever this inventory is actually sold, then only the capital gain will get triggered. And the above point A and B, okay, both will happen simultaneously. The effect has to be given for the both in the year when the stock is sold. I hope this is quite clear to you all. So the inventory is sold in the previous year 2019-20 for rupees 50 lakhs. I hope this is quite clear to you all. So how we will calculate capital gain? So for that, one more detail will be given to you in the question. The question will specify the fair market value of the capital asset, that is the 10 flats detail. Okay, that is the 10 flats fair market value on the date of conversion, that is in the financial year 2018-19. The fair market value will be equal to, say, assume 45 lakhs. I hope this is quite clear to you all. Okay, so how things will be calculated? This 45 lakh being the fair market value will be considered over here in the format. So we will understand this example with the help of our format only. Okay, so over here, first of all, we will calculate income chargeable under the head income from PGPP. Then we will compute income chargeable under the head income from capital gain. I hope this is quite clear. So firstly, we will mention the figure of this fair market value on the date of conversion. The fair market value on the date of conversion is 45 lakhs. Okay, that is mentioned in the example. So this fair market value figure of the date of conversion will become the full value of consideration for the purpose of charging income under the head income from capital gain. I hope this is quite clear to you all. So we will mention over here 45 lakhs. I hope this is quite clear to you all. So let's come back to the blank page and understand what all details are given. The inventory is actually sold in the previous year 2019-20 for rupees 50 lakhs. That means the inventory is actually sold for rupees 50 lakhs. So sale of such capital asset as inventory is 50 lakhs. Okay, so 50 lakhs minus 45 lakhs of the fair market value of the capital asset on the conversion date, and finally the balance amount which is equal to 5 lakh, this will become our business income. Okay, so the sale value of the inventory, okay, is given to us, as well as the fair market value on the date of conversion is also given to us, and finally we can calculate income from business which is equal to 5 lakhs. I hope this is quite clear. So similarly, now we will also be required to calculate income under the head income from capital gain. I hope this is quite clear. The full value of consideration is available. Okay, and the transfer expenses detail is not given in the example, so we will put a dash, and finally net consideration will be equal to 45 lakhs. So basically, in our example, our capital asset is a flat. Okay, and the flat is purchased in the year 2005 and 6. Okay, and it got converted in the year 2018-19. So the period of holding will be this much, okay, that is from 2005 and 6 to 2018 and 19 up to the date when the capital asset got converted into inventory. I hope this is quite clear to you all. So basically this capital asset, which is a flat, okay, so in other words it is a house property, so it falls under the range of 24 months, and since you can see it from here that the period of holding is by default more than 24 months, okay. So the capital asset, this capital asset, that is the 10 flats, is a long term capital asset. I hope this is quite clear. So we will calculate long term capital gain. I hope this is quite clear to you all. So one more detail is given in the question, that is the flat, that is this 10 flats were purchased in the year 2005 and 6 at the rate 15 lakhs. Since the capital asset is a long term capital asset, there is an option to the assessee either to follow indexation method, okay, or not to follow indexation method. I hope this is quite clear. But let's assume this assessee is following indexation method, then how we will calculate the index cost of acquisition? So that is also given in this format, okay. Here index cost of acquisition we will calculate in this manner. Cost, that is the actual cost of acquisition, we will mention over here, that is 15 lakhs as given in our example, okay, over here, okay. And further we will multiply it with index cost of inflation for the date of conversion. That means the year of conversion is 2018 and 19. Whatever will be the cost inflation index for the financial year 2018-19. Okay, for the financial year 2018-19, which is 280, will be considered in the numerator. 280 will be considered in the numerator, and in the denominator we will consider the index cost of inflation of the year of acquisition. The year of acquisition is 2005 and 6. Okay, so the index cost of acquisition for the financial year 2005 and 6 is 117. I hope this is quite clear. So let's calculate it over here only. 15 lakhs into 280 divided by 117, which is equal to 15 lakhs into 280 divided by 117, which is equal to 35 lakhs 89,744. I hope this is quite clear. We will take this indexation over here, 35 lakh 89,744. Okay. Since there are no detail about index cost of improvement, we will put a dash over here and we will take this amount 35 lakh 89,744 in the outer column, and finally we will calculate gross capital gain, okay, minus plus 45 lakhs, okay, which is equal to 9 lakh 10,256. There are no details about the exemption given in the question, so the final long term capital gain is 9 lakh 10,256. So on this long term capital gain of rupees 9,10,256, tax will be calculated at the rate 20% since the indexation is been opted by the assessee. But what if the assessee would have not opted for indexation? Then the calculation would have been changed, that is 45 lakhs would have been same, that is full value of consideration would have remained the same, okay. In place of index cost of acquisition, we would have considered cost of acquisition of rupees 15 lakhs, and this 15 lakhs we would have considered in the outer column, okay. So 45 lakhs minus 15 lakh will be equal to 30 lakhs, okay. So this 30 lakhs would have become gross long term capital gain, and since there is no exemption, we would have put dash only, and finally 30 lakhs would have only become the long term capital gain, and on this long term capital gain tax would have been calculated at the rate 10%. I hope this is quite clear to you all, okay. So I hope you all have understood how to calculate income under the head income from capital gain as well as income from PGBP if the capital asset is converted into stock in trade. I hope this is quite clear. So in the previous year 2019-20, the assessee has earned the capital gain income of 9,10,256 and also 5 lakh business income. Okay, I hope this is quite clear. So basically that's why this particular section 45 subsection 2 is known as a special section. I hope this is quite clear to you all. Okay, so now let's revise this entire section, that is section 45 subsection 2, conversion of a capital asset into stock in trade. So if a capital asset is converted into stock in trade, then let's come into notes first. Capital gain will be triggered in the year when the capital asset converted into the stock in trade is actually sold. That means when this inventory, that is when this stock in trade, that is the inventory is actually sold, in that year the capital gain will be triggered, and in that year only the business income will also get triggered, okay. The above point A and B, that means this point number A and point number B, okay, both will happen simultaneously the effect has to be given for the both, that is point A and B, in the year when the stock in trade is actually sold. I hope this is quite clear. And this is the format for calculating income chargeable under the head income from capital gain. The main point over here is whatever will be the fair market value on the date of conversion of this capital asset into inventory, we have to take this fair market value only as the full value of consideration over here. I hope this is quite clear to you all. Okay, and the remaining thing is same as we used to do in the earlier sums also. I hope this is quite clear to you all. Okay students, so now let's understand the special case number 3, that is section 45 subsection 3, transfer of capital asset to firm or AOP or BOI by the partner of this firm or by the member of this AOP or BOI. I hope this is quite clear to you all. So under whose hand it will be taxable? It is taxable in the hands of a partner of a firm who is transferring this capital asset to the firm, or it will be taxable in the hands of the member who is a member of this AOP or BOI who is transferring this capital asset to this AOP or BOI. I hope this is quite clear. So how to calculate the full value of consideration? Full value of consideration will be equal to amount recorded of such capital asset in the books of the firm which has been transferred by the partner or the member to the firm or AOP or BOI. I hope this is quite clear to you all. So it will be calculated in this manner. So the capital gain will be calculated in this manner. Full value of consideration, which is equal to amount recorded of such capital asset in the books of the firm or AOP or BOI. I hope this is quite clear to you all. Okay. And it will be further reduced by the transfer expenses, and finally we will find out our net consideration, which will be further reduced by the index cost of acquisition or cost of acquisition, and it will be further reduced by the index cost of improvement or cost of improvement. I hope this is quite clear. So basically we need to identify which is a capital asset which has been transferred to the firm or AOP or BOI. If such capital asset is a long-term capital asset, then the assessee will have the option to either follow indexation, okay, or not to follow the indexation. I hope this is quite clear to you. Okay, if the assessee is following indexation, then index cost of acquisition and index cost of improvement will be considered. But if the assessee who is holding a long-term capital asset is willing to not follow, okay, not follow the method of indexation, okay, then cost of acquisition and cost of improvement will be considered. But if the capital asset is a short-term capital asset, then only cost of acquisition and cost of improvement will be considered. And finally, we will find out a gross capital gain amount, which will be further reduced by the exemption under section 54 to 54 GB as applicable. And then finally, we will derive a long-term capital gain or a short-term capital gain. Long-term capital gain will be derived if a long-term capital asset is there, and a short-term capital gain will be derived if a short-term capital asset is there. I hope this is quite clear. So our section 45 subsection 3 comes to an end. It is a very simple section. Okay, we don't need to revise it also because it is very easy. Okay students, so now let's move on to the special case number 4, that is section 45 subsection 4, which says transfer of a capital asset by a firm or AOP or BOI to its partner or its member. I hope this is quite clear. The taxability will be in the hands of the firm, AOP or BOI who is transferring the capital asset to the partners or transferring the capital asset to the member in case of AOP or BOI. I hope this is quite clear. The full value of consideration in this case will be fair market value as on the date of transfer. Okay, I hope this is quite clear. So basically understand that when a firm is transferring any capital asset to its partner, okay, then the full value of the consideration will be equal to fair market value as on the date of transfer. Similarly, if an AOP or BOI is transferring a capital asset to its members, okay, then the full value of the consideration will be equal to FMV as on the date of transfer. I hope this is quite clear. The computation of the capital gain will be done in this following manner. It is similar to this earlier section, that is section 45 subsection 3. So I don't think we need to revise this again. Okay, we have already studied it over here. The same format will be applicable over here. I hope this is quite clear to you all. Okay students, so now let's understand the special case number 5, that is section 45 subsection 5, compulsory acquisition. So understand this compulsory acquisition in layman term first. There is this assessee. This assessee is having this house property, okay, and this house property has been compulsory acquired by government authorities, okay. So even if this house property is been compulsory acquired and such house property is a capital asset, then capital gain will trigger. How capital gain will trigger? As we have already studied section 2 subsection 47, there we have studied SEP REC, okay. Over there we have studied in this C1 as compulsory acquisition. I hope you remember that. So basically there is a capital asset and there is a transfer, okay. transfer includes compulsory acquisition. So capital gain will trigger. So whatever compensation for this compulsory acquisition has been received by this assessee from the government authorities, okay, it will be taxable under the head income from capital gain if such asset, okay, that has been compulsory acquired is a capital asset. I hope this is quite clear to you all. So there are two cases, okay. Case one is in case of initial compensation when capital asset is compulsory acquired, okay. So before understanding the main provision of this section, let's understand this section in a layman term, in a blank page. Understand that there is our assessee, Mr. A. Mr. A is our assessee. Mr. A is having a house property, okay. This house property is purchased in the year 2002 and 3 at the rate 10 lakhs. I hope this is quite clear to you all, okay. And this house property got compulsory acquired in 2016-17, okay. And the government authorities paid the assessee rupees 20 lakhs as a part consideration for the compulsory acquisition compensation. I hope this is quite clear to you all. So basically the full consideration for compulsory acquisition compensation is equal to rupees 50 lakhs, okay. So how it will be taxable under the head income from capital gain? So let's understand this, okay. We will understand this with the help of our format book. So come into our format book. So what does this point number A says? In case of an initial compensation when capital asset is compulsory acquired, full value of consideration is important, because full value of the consideration is a start point from where we will decide how much will be the long term capital gain at the end. I hope this is quite clear. So the full value of consideration is equal to full amount even if the part amount is received. For example, 50 lakhs is the compensation but only part amount of rupees 10 lakh is received, okay. So but in our example over here, the government authority paid the assessee rupees 20 lakh as a part consideration for the compulsory acquisition compensation, but the full consideration for the compulsory acquisition compensation is rupees 50 lakhs, okay. So basically this section 45 subsection 5 says that it is irrespective how much ever the amount you have received, okay, you have to consider the full amount that the government is going to pay you as a compensation for this compulsory acquisition. I hope this is quite clear to you. But the taxability of this full amount of the compensation will be in the year when the amount, that means the part amount, has been actually received by the assessee, okay. So for example, understand that the government has paid him this part compensation in the financial year 2019-20. So basically that is our previous year 2019-20, okay. So income from capital gain will be calculated for the previous year 2019-20 only. I hope this is quite clear to you all. And the full value of consideration will be equal to the full consideration for the compensation for this compulsory acquisition, that is equal to 50 lakhs, okay. Even if it is actually paid 20 lakhs, it is not the concern of the income tax department. They are saying that as per section 45 subsection 5, whatever is the full consideration that has been promised by the government authority that has to be paid to the assessee for such compulsory acquisition will be considered in the year when a part or any amount has been received by the assessee. So any amount has been received in the previous year 1920. So even if the actual consideration received is 20 lakhs, the full value of consideration will be equal to 50 lakhs. I hope this is quite clear to you all, okay. And if there are any transfer expense, we will reduce the transfer expense, okay. Since there is no transfer expense, we'll put a dash, and finally our net consideration will be equal to 50 lakhs. I hope this is quite clear to you all. The net consideration of the 50 lakhs will be further reduced by the index cost of acquisition or cost of acquisition. I hope this is quite clear. Assuming that this house property is a long-term capital asset and assuming that assessee is following indexation, okay. So we need to calculate the indexation for this house property. So the index cost of acquisition for this house property will be equal to the actual cost of the house property. The actual cost of the house property is equal to 10 lakhs. Okay, when this house property was acquired, it was acquired in the year 2002 and 3. Okay, and the actual house property which was compulsory acquired was in the year 2016-17. Okay, so that means this house property was actually transferred in the year 2016-17, but the consideration was received in the year 2019-20. Okay, so the taxability will be in the year 2019-20, that is the previous year 2019-20, or the assessment year 2020-21. Okay, but the indexation will be done up to the year 2016-17. Okay, and the period of holding will be considered up to this much only, that is from the financial year 2002-3 to 2016 and 17. I hope this is quite clear to you all. So let's calculate the index cost of acquisition. In the numerator, we will put the cost inflation index of the year 2016-17. That is the year in which the asset got transferred. Okay, that is what only is given over here, and the asset was actually acquired in the year 2002 and 3. So let's find out the cost inflation index for the year 2016-17 and 2002 and 3. Okay, so for that, let's come into our study material. The index cost of inflation for the year 2016 and 17 is 264. Okay, so let's come into the blank page over here again, and we will put over here 264, and the index and the cost inflation index for the year 2002 and 3 is 105. I hope this is quite clear to you. So we will put 105 over here, and we will erase this. Okay, and we will take this over here, and finally we will calculate the index cost of acquisition. The index cost of acquisition will be equal to 10 lakhs into 264 divided by 105, which is equal to 25 lakhs 14,286. I hope this is quite clear, and we will put the figure over here, 25 lakhs 14,286. I hope this is quite clear. Since there are no details about the index cost of improvement or cost of improvement, it will be dash. I hope this is quite clear. And finally we will get our gross long term capital gain. Okay, which will be equal to minus plus 50 lakhs, which will be equal to 24 lakh 85,715. I hope this is quite clear to you all. Okay, so from this gross long term capital gain, exemption can be further reduced, but there are no details about the exemption. We will put a dash over here, and finally our long term capital gain is equal to 24 lakhs 85,715. I hope this is quite clear. On this, tax will be calculated at the rate 20%, because the asset is a capital asset and assessee is following indexation method. I hope this is quite clear to you all. So I hope you all have understood this. So let's come into the format book now. Okay, over here what is given in part A: in case of initial compensation, when capital asset is compulsory acquired, full value of consideration will be equal to full amount even if the part amount is received. Basically, the chargeability of the consideration received for this compulsory acquisition will be chargeable in the head income from capital gain in the year when part consideration, part or whole consideration is actually received. I hope this is quite clear to you all. Okay, so that's why full value of consideration will be equal to full amount even if part is received. I hope this is quite clear. For example, 50 lakhs is the compensation amount, but only part amount of rupees 10 lakh is received. Then the full value of consideration will be equal to 50 lakhs. I hope this is quite clear. And we already know how to utilize this format, so revising it again and again is not so much important. Okay, over here there is the example that we have already studied in our blank page over here. Okay, but let's read it. Asset acquired on 2005 and 6 got compulsory acquired on 2014 and 15. That means the period of holding will be from the financial year 2005 and 6 to the financial year 2014 and 15. I hope this is quite clear. And indexation will be calculated up to the financial year 2014 and 15. I hope this is quite clear. And the compensation actually received, either part or whole, is received in the financial year 2019-20. That means the taxability will get triggered in the assessment year 2020-21, that is our previous year 2019-20 only. I hope this is quite clear to you. So you all might be thinking that See, full value of consideration, even if received in part, okay, we have to consider the full amount of the compensation that has been agreed by the government, okay. So what if at a later date the government pays us the remaining compensation, okay. So will that remaining compensation will also be taxable again? The answer is no. Whatever remaining compensation you will receive, in our example over here, we have only received 20 lakhs, so balance 30 lakhs is pending, okay. So this 30 lakhs whenever is paid by the government, okay, it will be exempt, okay, it will not be again taxable. I hope this is quite clear to you. But on this 30 lakhs, if the government is also paying the interest due to the late payment of this 30 lakhs, so whatever that interest has been received by the assessee, it will be taxable under the head income from other sources. We have already studied this part under the head income from other sources chapter, but I am revising it over here again. So any interest received by the assessee on the initial compensation, okay, that means the initial compensation is 50 lakhs, okay. So on this initial compensation, if the assessee is receiving any interest, so whatever the interest has been received by the assessee will be taken under the head income from other sources, and whatever the interest has been received, it will be reduced by 50%, that is 50% will be allowed as standard deduction, and the balance 50% will only be taxable under the head income from other sources. I hope this is quite clear to you all. So that is what the note is given in the bottom of this table, okay. So what does the note says? Interest on initial or enhanced compensation is taxable under the head income from other sources, and flat deduction at the rate 50% is allowed on such income from other sources. I hope this is quite clear to you all. So this much part, that is part A, is complete. Let's understand part B. Enhanced compensation. What does enhanced compensation means? We need to understand that in the blank page. So understand that initially government said that they will pay compensation of rupees 50 lakhs, okay, and government paid part compensation of rupees 20 lakhs in 2019-20, okay. But the assessee, but our assessee went to court, okay, and court ordered that government is underpaying the assessee, okay. So the government has to pay the assessee a revised amount of total compensation of rupees 80 lakhs. I hope this is quite clear. So you all tell me, how will you charge this event under the head income from capital gain? So it is very simple, don't take any stress, okay. So initially it was 50 lakhs, so we will follow initial part first of all, okay, and we will tax this entire 50 lakhs, okay. We will calculate the capital gain on this 50 lakhs over here as per this format A, okay. That is in case when initial compensation for capital asset is received, okay. So we will calculate it in this manner first of all, and then later when the court has ordered to give a revised payment of 80 lakhs, so this means that there is an enhanced compensation to be received by the assessee. I hope this is quite clear to you all. So basically the assessee is getting an extra compensation of rupees 30 lakhs. How? 80 lakhs minus 50 lakhs, and this 50 lakhs is already considered in income from capital gain. So this balance 30 lakhs, whenever the government will pay, it will be taken into the head income from capital gain. So how to calculate the capital gain on such enhanced compensation? That is what is only given in this point number B, enhanced compensation. So how we will calculate the capital gain on such enhanced compensation? We will find out firstly full value of consideration. Full value of consideration will be equal to this 80 lakhs minus 50 lakhs, which is equal to 30 lakhs. We will simply take 30 lakhs over here, okay, and then we will reduce any transfer expenses if given in the question, and if not, we'll put a dash, and finally net consideration will be equal to 30 lakhs. But there will be no index cost of acquisition or cost of acquisition or index cost of improvement or cost of improvement. I hope this is quite clear, because if there were any cost of acquisition or cost of improvement, it would have already taken over here in this calculation. Again and again, it will not be taken in this format also. Okay, once if that index cost of acquisition is taken in this format, it won't be taken in this format. That's why I've put nil over here. Okay, there won't be any possibility that there is one more cost of acquisition when the government has given an enhanced compensation order. Okay, whatever is the cost of acquisition, it will be predetermined, so it will be calculated in this table only, and at a later stage, when the enhanced compensation is received, index cost of acquisition and index cost of improvement or cost of acquisition or cost of improvement will be nil only. Okay, so whatever is the full value of consideration and further reduced by the transfer expenses, that means we will find out our net consideration. Whatever will be the net consideration, it will become our gross capital gain. That is, either it can be long term or either it can be short term. I hope this is quite clear. And this gross capital gain will be further reduced by the exemption under section 54 to 54 GB. I hope this is quite clear. And finally, we will find out long-term capital gain or short-term capital gain. I hope this is quite clear. Okay, so now let's revise this section, that is section 45 subsection 5, compulsory acquisition. Part 1 says that in case of initial compensation, when a capital asset is compulsory acquired, full value of consideration will be equal to the full amount even if a part amount is received. For example, 50 lakh is the compensation amount, that will only be considered as full value of consideration even if the part amount of rupees 10 lakh is received, and then we will compute the capital gain with the help of this format. Okay, I hope this is quite clear to you all. Then in case of an enhanced compensation, we will calculate the capital gain in this manner. Full value of consideration will be equal to 80 lakhs, which is the enhanced compensation, which will be reduced by the initial compensation amount of 50 lakhs, and the balance of this 30 lakhs will be considered over here as a full value of consideration. And if there are any transfer expenses, it will be further reduced. Okay, and in this particular format, cost of acquisition and cost of improvement will not be reduced. That's why I've written nil over here. And finally, we will calculate gross capital gain. Okay, and on this gross capital gain, exemption, if available, will be taken under section 54 to 54 GB, and finally we will calculate a long-term capital gain or a short-term capital gain. I hope this is quite clear to you all. Okay students, so now let's understand our very last special case, that is section 45 subsection 5A, that is redevelopment agreement. What does redevelopment agreement means? Let's understand it in a layman term. Understand that this is our assessee. This assessee is having a house along with the land. Okay, a builder, that is a developer, approaches this assessee and asks this assessee to give his property, that means the building as well as the land, to this builder for redevelopment, and in return the builder will give this assessee a flat in the building. Okay, in the building, plus a consideration. Okay, plus any consideration. I hope this is quite clear to you all. Okay, so basically redevelopment agreement means this only. Assessee is having a property, okay, and on such property a builder wants to redevelop. Okay, so in return the builder will give the assessee a flat in the building, which can be a bigger flat than as compared to his old house. Okay, and along with this flat, there is a possibility that the builder will give some consideration to this assessee. I hope this is quite clear. So that is what it is given in this section 45 subsection 5A redevelopment agreement. So let's read this. Old apartment building is going into redevelopment, then this is also considered as transfer. Okay, because this property is firstly a capital asset. Okay, and capital gain will trigger only when there is a capital asset plus transfer. Okay, I hope this is quite clear. So this point specifies that even this arrangement is considered as transfer. I hope this is quite clear. So capital gain will get triggered. I hope this is quite clear. How to calculate full value of consideration? In this case, when a builder is giving this assessee a new flat in the building and any consideration. Okay, so how we will calculate full value of consideration? Full value of consideration will be calculated in this manner. Stamp duty value as on the date of certificate of completion, okay, plus any other consideration received by the owner. And for this date of completion, there is a point given over here. Date of certificate of completion shall be taken of the completion of the owner's share is received. So understand this. Okay, so basically what is the idea of this builder? He will take this land from this assessee and he will build 3 buildings on this land. Okay, so if the assessee is going to receive a flat in this first building, So if this first building is completed before this first two buildings, okay, then whatever is the completion certificate received for this first building will be considered. Okay, so that is what is given over here. Date of certificate of completion shall be taken of completion of the owner's share is received. That means if this building is built and the assessee, this assessee has received his share, okay, in this building, so of that day the stamp duty value of the date of certificate of completion will be taken. I hope this is quite clear to you. Plus any other consideration received by the owner from this builder will be considered for calculation of full value of consideration. I hope this is quite clear to you. Basically, the question will provide us the stamp duty value of such property as on the date of completion of the owner's share. I hope this is quite clear to you, as well as it will also provide us any other consideration received by the owner. We just simply need to add this both and find out the full value of consideration. I hope this is quite clear. And then we will calculate computation of capital gain. How we will calculate? We will ascertain full value of consideration from here and we will mention it over here. If there is any transfer expenses, we will reduce it from the full value of consideration, and finally we will find out a net consideration, and net consideration will be further reduced by the index cost of acquisition and with the index cost of improvement if any, or with the cost of acquisition or with the cost of improvement if any, and finally we will find out a gross capital gain. Either can be long term capital gain or can be short term capital gain. Okay, and further it will be reduced with any exemption available under section 54 to 54 GB. I hope this is quite clear. And finally we will derive is long term capital gain or short term capital gain. Long term capital gain can be derived only when a capital asset is a long term capital asset, and short term capital gain can be derived only when a capital asset is a short term capital asset. I hope this is quite clear to you all. So over here basically the formula is given for calculation of index cost of acquisition and index cost of improvement. For this there is an example given over here. If the date of the acquisition of the apartment or the whole house property is in the financial year 2005 and 6, and the date of the apartment going into redevelopment is in the financial year 2016-17, and the date of certificate of completion is in the year, that is financial year 2019-20. So basically in this year capital gain will get triggered. I hope this is quite clear, and the period of holding will be from 2005 and 6 to 2016 and 17. I hope this is quite clear, and indexation will be calculated up to the financial year 2016 and 17. That is what is only given in this formula. So how to calculate index cost of acquisition? Actual cost of acquisition into index cost of inflation for the date of apartment going into redevelopment divided by index cost of inflation of the year of acquisition. We will mention it over here and finally find out index cost of acquisition. Okay, similarly we will calculate index cost of improvement is equal to actual cost of improvement into index cost of inflation for the date of apartment going into redevelopment divided by the index cost of improvement of the year of improvement. I hope this is quite clear to you all. And finally this section 45 subsection 5a and all the special cases comes to an end. Okay, so now let's revise this section, that is section 45 subsection 5a, redevelopment agreement. If the old apartment building is going into redevelopment, then this is also considered as transfer. Full value of consideration is equal to stamp duty value as on the date of certificate of completion plus any other consideration received by the owner, and then we will calculate capital gain. Okay, and the date of certificate of completion shall be taken of the completion of the owner's share is received. I hope this is quite clear to you all. And then there is a formula, that is index cost of acquisition and index cost of improvement. I hope you all are very well versed with all these formulas by now. Okay, so I hope you all have understood all the special cases. So let's move on to the next part. Okay.